slow down the process, get the central bank to wait until next year to do it and to start the lift-off, but the lift-off there will be.
Gilles, it's not inflation in Germany that gets my attention. In fact, inflation in Germany came down a bit. It's inflation in Italy and elsewhere. Yeah. Gilles, do you think that moves the dial this time around in a way that perhaps it didn't 10 years ago? 10 years ago, all it took was something with a two-handle to spook the Bundesbank. We're at 5 in Italy. That's real inflation again, Gilles. I just wonder how that moves the conversation a bit as we go deeper through the year.
Well, you have to be careful about all this because at the moment we have tons of idiosyncratic movements in many countries, in particular the way the increase in wholesale energy prices filter through to retail prices is heavily regulated in many European countries. So you have lots of idiosyncrasies like this, which can explain actually spikes. For instance, Spain, energy prices have increased a lot in Spain because of the way they actually deal with wholesale shocks. In Germany, the reason why it's slowing down is also because the VAT, because of the base effect of the VAT rate. For the time being, I don't think that there's much of a debate on cross-country differences. I think the focus is on the fact that inflation looks stronger than what is expected in general, globally, but also in Europe. I think the next step for everyone is to check how this plays out on wages, because for the time being, the big difference between the US and Europe is that yes, we have inflation, but it has not triggered anything significant on the wage growth. If we start seeing in the wage data in Europe that is definitely accelerating, then probably the ECB would have to change tack, completely. Yeah. But for the time being, it is not happening. It's still mostly an exogenous shock, which is taking more time than expected to get absorbed, and that is creating some tension and some concerns, but wages are not reacting so far.
But Gilles, time matters, and this has been the discussion in the United States as central bankers take a look at consumer expectations. It becomes ingrained when you start putting away the T word, the transitory word, and even if they subside in terms of the inflationary pressures, you have people who have a deeply ingrained sense that the price that they pay at the grocery store may be a lot higher tomorrow than it was yesterday. How does the ECB deal with the expectations of consumers, which seems to be such a huge talking point in the U.S.?
I think what they can say pretty easily tomorrow, for instance, is that it's not as if monetary policy in Europe had not reacted to the new situation. There is a QE tapering in Europe, which was not obvious just a few months ago. We know that PEP is going to end in March, that the quantum of purchases by the end of the year is going to be very, very small. So monetary policy is on a normalization path. So that's one thing they can say. But as we move along into the year, yes, I think the ECB is going to be increasingly clear that probably rates also are going to start moving, probably next year only, because you're right, they need to be seen as responding to potentially a drift in expectations. I think they have time to do this. It's not as prominent an issue as it would have been, let's say, 10 years ago, again in Germany. I also would argue that it's complicated for monetary policy at the moment to deal with inflation without creating significant adverse risks for the economy. That's a debate in the US, but that's also a debate in Europe.
And Gilles, to that point, there is an issue with how high yields can go in the Euro region based on the growth that has been lackluster, particularly in Germany. What's your view on that?
I think it's fair to say that the equilibrium interest rate in Europe is significantly lower than what it is in the US, simply because potential growth is lower. It's also the case that because of accumulated debt in a number of countries, the risk that you trigger systemic issues at a fairly low level of interest rates by historical standards is much higher than it is in the US. So you have a central bank which by nature, the nature of how our Eurozone works, a central bank which needs to be prudent. So yes, the terminal rate in Europe is certainly significantly lower than what it is in the US.
Gilles, just the perfect guest for this morning. Thanks for being with us, sir. Gilles Moek there of AXA Investment Managers. As inflation in the Eurozone comes in at 5.1%, the estimate was 4 1.4. A couple of years ago, Tom and I got in a bit of hot water with the ECB for calling the news conference. I think we called it, Tom, what was it? A snooze fest?
Yes.
Something like that. I imagine you might be able to stay awake in tomorrow's news conference, TK, given the recent data out of Europe.
Yeah, I think it'll be fascinating. And again, I've said this 3 days in a row here. It's going to be about the politics as Lagarde addresses a lot of legacy issues amidst, as we say today, this record high inflation.
Lisa, love that tease. Do you like that?
I love that.
The promo for the news conference. You might be able to stay awake tomorrow.
We normally call this a news fest, but tomorrow it might just be something.
You might actually stay awake. No, I think it gets interesting. We've got an ECB that's finally talking about raising interest rates. When the Federal Reserve in the last rate hiking cycle went and did its thing, the ECB sat out all of it. Mario Draghi never got the opportunity to raise interest rates. We thought maybe the same thing would happen to President Lagarde. Are we getting closer?
Well, here's the issue that I have. In the United States, people are talking about consumer expectations, that even if you have things roll off, that people are going to get ingrained into believing inflation. Why is that not a discussion at all in Europe as inflation climbs to the highest pace in modern history? I mean, real yields right now are almost negative 5%. Just going back, I mean, they're still at historic lows when you take a look at the Euro region.
What's great about that is Lisa just mentioned 5%, John, and that's a magic number because we see in the Dow Jones Industrial Average that Microsoft is 6% of the index, McDonald's is 5% of the index, where in the S&P 500, McDonald's is only 0.5%. McDonald's has a 10 times greater weighting in the Dow Jones Industrial Average than it does in the correct Standard & Poor's 500.
That's
right. And John, what's important is no one cares.
He's going to keep going. He's going to keep going no matter what.
You're going to wind me up all morning, aren't you? You haven't done a banner for it. Futures on the Dow.
The Dow.
I'm not even going to do it. NASDAQ futures up 1.4% from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In the euro area, inflation surprisingly speeded up to a record in January. Consumer prices jumped 5.1% from a year ago. None of the economists surveyed by Bloomberg saw inflation accelerating. It's the latest challenge to the European Central Bank's plan to pare back stimulus more slowly than its counterparts in both the US and the UK. Federal Reserve officials have a message for investors ramping up interest rate expectations not so fast. None of the 6 Fed officials speaking this week have backed the idea of a half-point rate increase in March. The most aggressive, St. Louis Fed President James Bullard, said that 5 hikes this year is not too bad a bet. Some Wall Street forecasts are even calling for 7 increases this year. In Congress, there's growing Republican opposition to a once bipartisan bill intended to make the U.S. economy more competitive. House Republicans say the measure goes too easy on China whilst trying to aid the domestic semiconductor industry. The legislation is aimed at bolstering U.S. manufacturing, research and development. And in Winston-Salem, North Carolina, there's still the risk of an explosion at a fertilizer plant after a fire that forced thousands to flee. The blaze erupted Monday night at the Winston Weaver facility. About 6,000 people living within a mile were told to evacuate. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is totally the decision of the management of each company after carefully taking all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's individual circumstance and decisions.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It's inevitable that they're going to get COVID cases, especially with the Omicron variant, its ability to evade immunity, and some questions about the efficacy of the Chinese vaccines. All of that is going to cause a perfect storm for their COVID zero policy. It's going to be something that the world is going to see, and their population is going to see that this was not a sustainable approach to a virus that was always destined to become endemic.
Dr. Amish Adalja there, Johns Hopkins Centre for House Security Senior Scholar with Tom Keene, Lisa Bramett. I'm Jonathan Ferro. Your equity market has a nice lift to it, up 0.75% on the S&P. On the Nasdaq 100, up by 1.5. Google, Alphabet, in total, making up a little more than 7% of the Nasdaq 100. Just for you, Tom. Not in the Dow, but they're trying to work that out, aren't they? Futures on the S&P higher. Yields unchanged on 10s at 178.76. And crude, it sticks. TK, an 88 handle.
And, we don't need to do it now, John, but if Google and Amazon split, and if they enter the Dow, who exits the Dow?
That's a good question, Tom.
Do you take out other tech like Intel and Cisco?
You take out the name with the lowest
Walgreens
price, don't you?
aside?
Isn't that what you would do? I'm making that up.
I
have no idea, Tom.
No, I think they take this very seriously, and
unlike John,
it's interesting to see who will go out the door if they enter the Dow. We can say that for another moment. Here in the pandemic, and as John Farrell mentioned, folks, great news. Bakhti Ansari joins us, Associate Professor of Emergency Medicine, Johns Hopkins University. Bakhti, cases roll over, hospitalizations roll over. Do you just presume deaths will roll over from 2,500 a day?
I do think so. I think there's a lag in deaths for sure. There's a number of patients still in the ICU. But yes, death rates will most definitely go down as we see caseloads decrease.
As death rates go down and we say all clear, do we have to pay attention to other climes like India or South Africa? Name the next country where there's a next variant?
Yeah, so globally, cases continue to rise, right? We've seen a 14% rise in cases over the last 2 weeks. Similarly, globally, deaths continue to increase. We're a global society. So what happens in other countries matters here in the United States of America, and we have to watch very carefully.
Dr. Ansari, there have been a number of studies showing that COVID has been killing the people in the United States at a much higher rate than in other developed market countries. How much can we take a step back, look at the post-pandemic period, and figure out what the problem is with the healthcare system in the U.S.?
Exactly. So this is like the COVID pandemic has given us some significant lessons. One has been about misinformation, but the other has been about our health system, right? For example, what happens to patients now who are going to have long COVID, right? How will they access care? What primary healthcare services are available? How does this impact their livelihoods or their ability to do jobs? And we also can see that the lack of primary healthcare has resulted in higher numbers of diabetes, hypertension, morbid obesity, resulting in higher deaths in the United States compared to other countries.
I'm struggling also with Dr. Ansari, some of the data coming out of hospital systems in terms of the number of professionals leaving the healthcare industry. I was looking at a study showing that New England, which traditionally has a much lower unemployment rate than the rest of the United States, has a much higher one now because of the lack of people in the healthcare industries and education. What's the main driver for these exits?
I think the main driver is burnout, right, and lack of sustainability. So while children had to stay home due to a COVID exposure in their classroom, parents who belong to the healthcare industry still had to go to work. If we did not go to work, there was consequences to those actions. That lack of work-life balance, that inability to be supported to manage both your family and your professional lives has led to burnout and people making very difficult personal decisions.
Bhakti, when do the masks, when do the silly plastic around the desks and all that, what's your framework of when all of that goes away, other than people that want to wear a mask because they're comfortable wearing a mask? I mean, we saw that in Asia for decades. I mean, I get it. But when does all this silliness, this anti-science go away?
Oh, first of all, it's not anti-science.
Oh, come on. The plastic around the desks, there's scientific justification for it?
Absolutely. So the virus is spread through aerosolization when someone coughs or speaks at you. Some patients do not always have an ability to have masks on. That plastic provides protection to service providers. So it's not silliness at all. It's a physical barrier to decrease transmission. Right. When does it go away? I'm not sure. I think likely when we get to a stage where we're comfortable that there isn't going to be a future surge that will result in hospitalizations and death, as our under fives get vaccinated, as we move past Omicron, I think it's in our near future.
I mean, Lisa, I look at this and, I got to sit next to Matt, Lisa, and you know what that's like. Matt's like Big Ben in the cartoon Peanuts. He's a walking cloud of virology because he's in every bar in Brooklyn all weekend. But I just, Lisa, I think these are questions America's asking right now. Is John saying we got great statistics? When do we start getting back to normal?
Right, and how do we get to a post-pandemic normal when there are a lot of people who believe that if they get COVID, they're automatically going to die, and if they get a cold or even the flu, it's totally fine? Dr. Ansari, how do we shift to this scenario where every illness is treated more equally rather than if it's COVID, you're going to die, if it's anything else, go out and keep coughing on people?
Well, first of all, don't go out and keep on coughing on people if you have the flu, because flu also kills. However, having at-home testing means you know what you have, right? So you can protect yourself and others around you. The mortality from COVID decreases if you're vaccinated. And also, what is our new normal? I don't remember, do you? What normal was 20 months ago when we would have had these conversations in person. So we need to redefine a new normal and make sure that aligns with our norms as a society and what brings us joy. And I do like personal interactions. I love hugging and I love French kisses, but I'm going to be selective in who I hug and who gets those French kisses.
Doctor, I hope you're selective about the latter, that's for sure. Dr. Bhakti
Is this
Hamsati.
appropriate
Thank
for
you.
family
I mean,
television?
I don't know where this was going in the end. I mean, I hope people are selective about doing those things.
Oh my God.
Completely inappropriate for radio. TV, I can go either way.
I didn't go there. Let's be clear about that.
She's talking about, okay, never mind. Wordle brings me joy. I'm with you, Dr. Hamsati. Please don't leave us.
Bhakti, don't leave us. Bhakti, do you play Wordle?
I do, addictively, but I didn't get today's in today. And
Okay.
I'm also into Nerdle, which is challenging.
Okay.
There we go. Can a kind doctor go now, Tom?
Yeah,
Thank you.
Doctor, thank you.
John, what's the capacity of the Super Bowl? I mean,
TK, I don't know.
What?
It's in California this year, isn't it?
80,000
It's in LA,
people?
isn't it?
Is it big enough to go in the Dow?
I don't know.
It is big enough to go into the Dow. I've got no idea. TK, you should clarify the question you asked, though, because it was important. There's a difference between the plastic barrier at, say, a store, a Dwayne Reed, a Walgreens, separating you from paying. There's a difference between that and, say, the cubicle, the plastic around the
I'll
cubicle.
look at my Twitter feed after this.
I don't know. The numbers, John, as you mentioned, they're regional. Let's be clear about that. Idaho's not New York, but the bottom line is, John, hey, we got good news. What's the barriers or the measurements that tell us this is over, like when Google and Amazon joined the Dow?
This segment's over. Should we pretend it never happened? Futures up 1.5% on the Nasdaq 100, on the S&P up 0.8%. From New York, this is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is dancing on the head of a pin for the Fed.
This is not a Fed that's committing to forward guidance.
They're attempting to engineer a soft landing. Fortunately, the risk of recession is exceedingly low.
The big fear is the Fed's going to be more aggressive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Big tech making a comeback from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your NASDAQ, Tom Keene at 1.5%.
It's the way it's up 1.5%, John. It's a lift. We had Microsoft sequentially to Apple and now Google, Amazon, I believe tomorrow, Facebook this afternoon. It's a renewed confidence in what Ben Laidler calls these defensives. They got moats around them and the moats filled with cash flow.
Alphabet with a monster move at a pre-market, Tom. Let's talk about the numbers, not the stock split. 33% ad revenue growth in the Google business, just phenomenal.
Long ago, John, Tom Galvin at Donaldson, Lufkin, Genret made his acclaim on sales and revenue. Start at the top line and go down. That's what we see here, and it's true with Apple as well, where they reaffirmed iPhone. But the answer is, okay, not 30. Do you go down to 25? Do you go down to 22? What's your run rate for Google out into the distant future? That's how you adjust price.
Alphabet up more than 10%. Lisa, the numbers looking good.
Especially given the fact that it was advertising revenue, which is driving Facebook's gains that we've seen in pre-market. It seems like that cyclical push still very much there. I'm just getting whiplash because the narratives have gone from a reason to a slowing growth scenario and people gotten a little bit too sanguine about the Fed to, oh my goodness, look at those earnings. We're all in a fantastic place and growth keeps going.
Nothing changes the mood quickly enough, like price.
I mean, seriously.
I mean, how quickly has the price move been over the last 3 days, Tom?
Yeah, I did the measurement this morning. It's easy to do with a net change study on the Bloomberg terminal. The VIX is in 17 big figures. 17, John.
And the Nasdaq's moving again. It's the fourth day of gains potentially. Let's whip through it on the S&P.
Please.
Up 0.7% on the Nasdaq 100, up more than 200 points. We advanced by 1.44%. Dan Ives of Wedbush say the tech bears can go back into hibernation mode with this jaw-dropper Alphabet quarter. We'll talk a lot more about that quarter a little bit later in the program. Yields unchanged on 10s in the US, 178.76. But look out Europe. Euro dollar positive by 0.4%, 113.16. Lisa, upside surprise on Eurozone inflation.
Very much front and focus given the ECB meeting tomorrow. I feel like you're trying to tweak me, John, when you say the bears going into hibernation. You know, maybe not all of the bears. Meanwhile, today we are looking at the oil prices. OPEC Plus members are expected to increase output. It's expected to be a modest increase of about 400,000 barrels a day. The idea here is they want to raise production. They want to keep prices where they are, perhaps a little bit lower. But can they increase production at a time when a number of nations are really constrained on that front? 8:15 a.m., we get ADP private payroll numbers. Nobody cares, but people are trying to figure out what it could potentially mean for wages. Really, honestly, at this point, John and Tom, we've basically shrugged off anything that we could get from the headline number of Friday's report. The Fed and President Biden have tried to make that clear. However, wages could offer a surprise in terms of momentum here, especially with job openings yesterday increasing much more than people had expected. And aftermarket, Facebook, not Meta Platforms, is reporting fourth quarter earnings. I will call it Meta Platforms just because, you know, that's what they call themselves. Up now 3.6% in pre-market activity. How much does Alphabet or Google really act as a predecessor to what we can expect with Facebook and really Amazon tomorrow? We're going to talk about the stock split. How much at a 3,000 plus share value are we going to look at a stock split for Amazon?
Tom's been talking about it for a while, getting some feedback here. Tons of feedback this morning. Thank you for that. From a Bloomberg subscriber, Tom. Facebook is Facebook, not Meta. Google is Google, not Alphabet. Dow quotes everywhere. This is madness.
It is
madness, Tom.
I mean, here's the madness. So it's like John and I, we go back and forth, and I understand the heritage of the Dow, the echoes through my house of my childhood. Okay, forget about that. Goldman Sachs in the Standard & Poor's 500, properly weighted, is number 77 stock out of roughly 500. John, in the Dow, it's number 3.
What's the difference between a market cap weighted index and a stock price?
We're informing the public, John. It's a service on radio and television.
I'm pleased we're doing that.
This is what we do.
Is this informing?
This is informing the public. Stock splits don't make a difference, except other people think it does, so I guess they do to some degree.
It matters to congressmen in Washington. This is baloney, John. I'm going to get on my podium now.
You really think this is political, don't you?
Yes, I do,
well, then
and I agree with Charlie Gasparino on Fox. These people are being told by their lobbyists and advisors, get off your podium in Seattle, in Silicon Valley, and well, guess what? Welcome to America, and America is the Dow Jones Industrial Average, and I'm talking for Republicans and Democrats in Congress.
You think that little of policymakers in Washington, that you think just bringing the price down and not the overall valuation of the company, not changing anything but just the price of a single share, making more shares, making it accessible in the Dow. You think that little of them, that you think that makes a difference?
They think they're arrogant West Coast technologists, and guess what? They're saying, get off your high horse, and one way to do that is to enter the Dow.
Your big call is that Amazon follows. We'll find out tomorrow. You've been calling that one for a few years, so maybe we're closer to that point. Evan Brown joins us now, multi-asset strategy head at UBS Asset Management. I won't ask you that question, Evan. Don't worry. I'm going to ask you about the note that you wrote with Luke Cower. I thought it was fantastic. What we've seen is a valuation-centric adjustment. You don't think it's a growth scare. How do you draw a distinction between the two, Evan?
Well, I mean, a lot of it is just looking at prices cross asset. And if it was really a growth scare, you'd expect to see more widening in credit, which we just have not gotten. You wouldn't expect to see EM outperforming, which is what we've gotten. So we look cross asset, oil too, holding up really well. And so we don't see it in price, but also it just doesn't really make a lot of sense economically when you have income growth almost double what it was last cycle. So it's still a strong economy, still strong nominal GDP. And as Powell said last week, we're in a different cycle than the last one.
Well, let's sit on the valuation scare for a minute, Evan. How do we determine what the scare should be in terms of what real rates are going to be with the Fed action? And sort of how do you game that out with respect to what's already happened in markets?
Yeah, so I think first of all, the point is that the Fed wanted this, right? They want a tightening of financial conditions. It in their view, is a way that's going to cool inflation down the road and extend the cycle. Now, it's up to them to decide how much. We saw quite a hawkish Fed, but then now you're seeing a parade of Fed speakers this week saying, hey, we're not going to do 50 basis points at the next Fed meeting in March. So, it's a dance between the Fed and markets. I think the frothier areas of the market will continue to have headwinds, unprofitable tech, these kind of things. But the more cyclical areas of the market, I think we're unfairly punished in this more recent sell-off, and those are going to be the big gainers over the coming weeks and months.
Evan, what do your analysts say about the ability of corporations to adapt to sustain margin? The first thing I did yesterday with Google is go to look at the margin, and it was a fractional lift off the parlor game of guessing margin. But what, sector to sector, the 200 analysts you've got at UBS, what do they say about the ability to sustain margin?
I mean, margins are fine in the data. We don't quite have what we've seen over the last couple of years, but so there's some moderation there. But overall, the message that we're getting from corporates is really strong pricing power. And so, we just look at the data, and yes, the analysts internally, and we just, even with higher wages, we see that higher pricing power. So it just does not appear to be a major concern at this point.
Evan, where are you and the team on the rest of the world at the moment? Big surprise for some people through the first month of the year was the relative outperformance of, say, emerging markets. Is that something you think can persist?
I think it can, actually. We had the difference between this year and last year is China's easing, right? We're not going to see the boom in credit growth that we got in the previous cycle, those boom-bust periods, but they've put a floor on GDP growth, and that has implications for the rest of the world. So emerging markets, I think, can have a better year. We think the dollar is kind of weakens from here, or at least stops strengthening. Europe, I think, will look back on 2022 and say, this was Europe's year. It's not just the solid global growth outlook, but you've got all the green spending. You've got more political cohesion, certainly, than we saw last cycle. You've got really strong balance sheets, and you've got inflation, right? And that should put upward pressure on yields, and higher yields is good for financials. So we really like the rest of the world, and we think the rest of the world will outperform the U.S. For the first time in a while this year.
Higher yields haven't helped out the U.S. banks in a big way year to date, Evan. Do you have more confidence they will in, say, Europe relative to what we've seen in the U.S.?
Well, I think there's a bigger valuation discount in European banks. Not I think, I know. and also, you have more room. I think the bond yields at 0%, that is extraordinarily low. We all know the presence of the central bank there and downbeat whether Europe and Europe can sustain growth and inflation over the medium term. But the valuation story is there. There's a lot more room in bond yields to reprice, which should help European banks. And it's a really positive story. We're seeing it in the earnings as well.
Evan, thank you, buddy. Send our best to the team and to Luke too. It's great to catch up.
Don't send it to Luke.
Evan Brown.
Appreciate it.
Of UBS. Why can't we send our best to Luke?
Because
what's wound you up this morning? You got your stock split over at Google. What are you unhappy about?
Amazon.
That's true.
He's waiting for Amazon to come
exactly.
up. That line from Evan, let's sit on that just for a while, Lisa. This is Europe's year.
Yeah.
That quote from Evan Brown at UBS.
I find this actually one of the most compelling bets, that basically we've baked in all the hawkishness of the U.S. and the Euro region has to respond in some capacity. How much can Christine Lagarde really hold on, which means that we should probably travel to Europe more often.
He's already planning it. Go on, Tom.
Francine was in Italy doing the elections. I just see us in Rome doing the artichokes.
We should have gone.
There's that place in Rome, it's just past the Jewish Quarter, where they have the artichokes with like the lemon. And
you know it better than I do.
So good. With olive oil, lemon. Actually, Luke Kawa does a really mean fried artichoke. I found out on his Twitter.
No, but I've never eaten at Luke's.
No, but I've seen his pictures.
I've seen the pictures too. I've never had an invite.
There's a Motel 6 at the top of the Spanish Steps. We could stay there.
Hey, that is not a Motel 6, and you know it's not. Tom Keane, Lisa Bramis, and Jonathan Ferro. No doubt your town management that time.
I am all over
And then they'll see the bill. Futures up 1.6% on the NASDAQ, on the S&P up 0.8%. For our audience worldwide, good morning to you. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Russia's President Vladimir Putin is repeating his claim that it's the US and NATO causing tensions over Ukraine. At the same time, Putin suggests that further talks could help resolve the crisis. US and European officials say they are open to diplomacy, but they won't agree to a key Russian demand that Ukraine be barred from joining NATO. The Biden administration is lowering expectations for this week's jobs report. The White House says that brief absences of workers due to Omicron could overstate the number of unemployed people for last month. Surveys for the January payroll numbers were said to have been taken as coronavirus cases soared. And OPEC and its allies are expected to approve another modest oil output increase today. At the same time, they'll have to struggle to deliver. In November, the group only implemented about 60% of its increase. Members from Nigeria to Russia have been running out of spare capacity, and it's difficult for them to revive output after what's been years of cuts and underinvestment. And Alphabet is bringing big stock splits back to the market. The Google parent announced a 20-to-1 split, dropping the share price to about $140 from almost $3,000. The split could help Google gain entry to the Dow Industrial Average. Shares of PayPal plunged after saying that spending on its platform kept slowing in the fourth quarter. The problem? Economies around the world reopened and consumers flocked to stores to do their shopping. Plus, former parent company eBay keeps moving payment offerings away from PayPal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Earnings season continues.
This is record revenue.
Not since the 1980s have we seen these sorts of reversals.
Strong earnings put investors' Fed fears behind them for now.
Bloomberg breaks the numbers first.
A big beat for Apple.
Caterpillar earnings.
Got McDonald's earnings.
An expert analysis you won't get anywhere else.
The fundamental story is really solid.
The supply chain shortage is still very much real.
It's really kind of a balancing act.
You run the risk of not holding the stock that makes its peers obsolete.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Clearly, it is Russia aggression now. 100,000 plus troops, a daily drumbeat of additional troops, supplies. I actually think the next few weeks are going to be some of the most challenging.
Senator Mark Warner there, the Democrat from Virginia, from New York City, alongside Tom Keene and Lisa Brammertz. I'm Jonathan Ferro. Here's the shape of things for you. A lift in this market. We could have a 4th day of gains on the NASDAQ 100, badly beaten up through much of January. Then the bounce back through the back end of last month and into this month too. 3 days of gains into Wednesday. Looks like it could be 4. NASDAQ futures up 1.75%. We'll talk a whole lot more about Google a little bit later. That's leading the way this morning. The S&P up by 0.9%. And the bond market, let's just say this. The bond market, Tom, behaving 178.22 going into payrolls on Friday.
Well, going into earnings as well today. I agree payrolls is a big deal. And of course, we got ADP, Michael McKee with wisdom here in exactly 1 hour. John, I'm sorry, but we got a new leg up in NASDAQ futures right now. Not that I care, 800 points from 16,000. But don't you agree there's a certain oomph today which really centers on getting to Facebook this afternoon?
And I don't think it's just a relief, Tom, by the bond market settling down from that to the equity market. It's the earnings that we've seen from some of the big names. Will Amazon disappoint? Because Amazon did nothing for anyone last year, Tom. Hardly any stock returned in a market that was up in a big way.
And it's about containing costs there. I mean, there's a partition there. I lean on the sell side. Joe Feldman does a great job at Telsey and others, John. And there's a huge optimism. Doug Cass at Seabreeze re-emphasized that yesterday. But you're right. Is Amazon the same as Google when you're moving cardboard boxes down 3rd Avenue?
You might get your stock split. You're excited about that, aren't you?
No, I'm not excited about it.
Years,
it's just, it is a sea change for the technologists on the West Coast, starting by Apple. and others as well. Let's go to Anne-Marie Horton right now. We're focused on Washington. I'm going to talk to her about artichokes here in a minute, but let's do Washington here for a moment. Anne-Marie, I want to know what the left's doing. Bernie Sanders was livid in the reports the other day with Mr. Manchin. How's the progressives January? What do the liberals do to get to February?
Well, they can't do much unless they get Senator Joe Manchin on board. Listen, it's the same story of 2021 that they're dealing with in 2022. Anything they want in terms of Build Back Better, pieces of or chunks of which the president thinks he could get across the line, has to get every single Democratic senator on board. And Senator Manchin made it clear yesterday. He said, that bill that you were discussing, Build Back Better, that title, that is dead. But there does seem to be some signaling that there are some issues they could potentially work through. But that's just when it comes to Build Back Better. I have to say, the Hill is focused on a number of different issues for February before they go into the State of the Union March 1st. One is this China competitive bill, which we should get a procedural vote in the House on today. Then, of course, the government shuts down. There's no more funding left after February 18th. So you have the appropriations committees working on that as well. And then, of course, there's this looming sanctions bill with bipartisan support against Russia. So there's a number of agenda items being discussed on the Hill. Build Back Better at the moment is really taking a backseat.
Are we really going to have to talk about a government shutdown again? Is this really a thing?
Good question. Good question.
You know, and I was looking at Jack Fitzpatrick's tweets yesterday because he stands outside those meetings where the appropriators are meeting, and he said, no deal just yet. I said, oh, gosh, I hope this doesn't mean you have to talk about it, because when you talk about a government shutdown, then we have, of course, the looming and the perennial debate in Washington, which always happens after, is the debt ceiling. So there is still time, potentially. I mean, I'm not going to write off that we're going to not talk about it. There's still time that they have some sort of stopgap funding measure that gets them through a number of months.
Anne-Marie, has the debt limit and the debt ceiling debate changed at all based on the growth rate in the United States? I mean, honestly, this is a serious point with Morgan Stanley coming out with data showing that actually we've closed the fiscal gap on a debt to GDP ratio that was incurred during the pandemic as a result of the growth and the inflation. I mean, how much is that informing the discussion, if at all?
Right now, it's just not a discussion on Capitol Hill in terms of the debt ceiling. It would be, of course, if we come up to these limits again. And we see this time and time again be used in Washington. Then they debate, maybe there's a way we can get around the debt ceiling. And they always, at the end of the day, for the most part, come to an agreement. No one wants to go back to what happened in 2011. We were on that brink, and the United States suffered a credit downgrading.
Anne-Marie, the politics here of Biden, he's got to recapture momentum. He's doing the symbolism of going to New York and all that. What are you hearing from his team about what the plan is for February?
Well, Biden made it pretty clear that what he wants to take on in this new year and maybe a potential reset is he wants to get out of the country more. We saw him go to Pittsburgh. We're seeing him go to New York. But on top of that, he also wants outside advice. Now, you're hearing a lot of individuals like James Carville, longtime Democratic strategist, giving the administration hints on how they can get the train back on the rails in terms of getting their poll numbers up, which the president said clearly in that his press conference he doesn't pay attention to. But it's focusing on the issues in the last hour Jonathan mentioned, which is schools, which is inflation, and which is crime. And it does seem these are really the kitchen table issues leading up to the midterms that Americans want to hear more about.
We thank everyone on Twitter.
What are they saying?
Emails as well. Emails are coming in fast and furious. John, you got to weigh in here with the restaurant ability you have and your Italy as well. Come on, Anne-Marie, cut to the chase. There's two kind of artichokes in Rome. I go to La Scopatetto, you go to Da Giotto. There's the Jewish artichokes fried, and then these gorgeous monstrosities hand-peeled in lemon. I mean, it is the place for artichokes.
Yes, Rome is the place for artichokes, especially as we are nearing spring. I prefer carciofi alla Judea of the Jewish Center in Rome. They're incredible. Francine Lacroix, also partial to those because I've been in Rome with her. Not sure where Jonathan stands on this debate.
John, where do you stand on this?
I'll give you my opinion. I would suggest to the president, if you want to get things back on the rails, do not take any advice from Tom Keene about how to speak to the public, because this ain't going to do it. Hey, mates, just quickly, if he's speaking to Carville, that sounds me. He's not just looking to put things back on the rails. It's to get back to the middle. Because every time he speaks, that's what he's talking about. Is that the effort right now?
Well, that's what Carville thinks needs to happen, right? And this was a president that many moderates say he ran to be a moderate president. What was Representative from Virginia saying? We just wanted someone who was normal. Abigail Spangberger saying we just want someone who's normal. So going into the midterms, potentially that is what we will see from this administration, especially since many believe he pushed too much to the left the prior year.
Yeah. Lisa, did we not get an artichoke opinion from Restaurateur Faro?
Well, no, he didn't, but I can give you mine.
I'm not here to give you one. Go on, Lisa.
Carciofi alla romana. Love that. How is that? Good? Brava.
Yeah.
John is mortified right now.
Futures up 9/10 of 1%.
He's like, get me out of here.
On the S&P, on the NASDAQ, up by 1.7.
Look at those markets.
It's turning into the cooking show.
It's morning, you know?
Seriously. 178.22
on the 9 o'clock hour.
That's exactly what I do.
Shopping and cooking.
From New York.
Loaf with John.
This is Bloomberg.
U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
What sell-off? What a bounce back on a Nasdaq 100, 3 days and up 7%, bouncing back and eating into the losses year to date for 2022. In the equity market right now, up 0.9% on the S&P, on the Nasdaq 100 up by 1.74. Alphabet, a big piece of this. We can talk about that in just a moment. So the equity market bounces back, and in the bond market, we behave. For now, we back away from 120, then push a little bit higher again on twos at the moment, unchanged at 116.55. Going into payrolls, which everybody will tell you does not matter. Look ahead to inflation. CPI next week in America, a sneak peek of the estimates, north of 7 so far. We'll keep collecting them for you. Your 10-year in America, 177.69. Yields come in about a basis point. So this curve is just a little bit flatter again. 30s down to just below 2.1%. That's America. Let's talk Europe. The ECB on deck tomorrow. Euro dollar firmer, stronger euro, up 0.5% on that currency pair and back with a 113 handle. And look out at the very front end of the German yield curve. Twos inside that deposit rate of negative 50 basis points. We trade up to about negative 46 now, Tom. And it sets us up for a really interesting conversation tomorrow. Inflation at a record high in the Eurozone. It's north of 5. We thought it would come back to the mid-4s. It has not. Does it tee up a rate hike? Not tomorrow. I'm not talking about tomorrow, Tom. In the back half of this year.
And John, what's so important here, to your great observation, and I love the HSBC note this morning on this, is if you have a widening spread, a transatlantic difference in yield between a buoyant America and a less buoyant Europe, what does that do to the dollar calculation for business?
It's going to be really complex, Tom, and there's several moving parts to this, so let's sit on one. Rate differentials. Right now, we've priced in a lot for the Federal Reserve. So it's not about who hikes more, it's about changing probabilities. So how do you get an upside surprise on 4 or 5 hikes for 2022 from the Federal Reserve? Can you get an upside surprise from the ECB, Lisa, if we're only baking in, what now, 10 basis points? Yeah. Middle of this year, perhaps, and perhaps, big asterisks on that.
How much can people really rely on the idea that the wage dynamic is so different in Europe, and how much can people start to say, wait a second, when you start to see a 5.1% inflation rate, that gets people's attention and it affects consumer mood?
It's got my attention. You know, 18 months ago, I thought if you'd asked me, the ECB could go a full cycle again without hiking interest rates. Not just my view, it was the view of a lot of people I'd spoken to. Even a few months ago, some people would have held on to that. That's changed in a big way. Euro dollar 113.23. That's the cross-asset price action. Let's get you some single names. One big mover we need to discuss. Let's say good morning to Romain. Good morning, Romain.
Yeah, a lot of stocks moving this morning, but really the only one everyone's talking about is Alphabet. We talk about Alphabet as a tech company, but really it's basically an ad business. It's all Google, and it basically is on fire. One of the best ad businesses out there, 33% growth in that ad business on a revenue basis, 40+% growth in terms of operating income here. If there's anything to quibble about, you can sort of look at that cloud business, which is sort of lagging some of its competitors, but overall, investors pretty pleased here. Shares higher by about 10.4% here in the pre-market, above $3,000 a share, Tom. Don't worry, though, they're doing a stock split 20-for-1 here, so I guess that brings the valuation down. I'm not exactly sure how that works, but if you're looking for an entry point here, maybe that makes it a little bit more accessible. At least that's the theory among some folks out there. Ruth Porat at least trying to make that case here. Keep an eye on Snap as well. A lot of the other companies that rely on that digital advertising also moving higher. Snap shares up about 4%, as is Meta Platforms up about 4% as well. Those earnings after the bell. We'll take you to the metaverse when those earnings hit after 4 p.m. Flip up the board real quick. While Alphabet is up 10%, it's actually not the biggest mover here in the pre-market. That actually belongs to AMD, up about 12.5%. In fact, the 1-2 punch right now of Alphabet and AMD is a big part of the reason why you're seeing NASDAQ futures up about 1.8%. 2 down notes to keep an eye on. PayPal down 16%, Starbucks down 2.7%, both dealing with a little bit of the bloom coming off the rose of some of those pandemic gains that both had, Tom.
The close important this afternoon with Romain Bostic. Look for that on Meta and, of course, Amazon onto it tomorrow. We're in the heart of earnings season. Right now, Jane Foley joins. She's head of foreign exchange strategy at Rabobank with their wonderful commercial interests worldwide. Jane Foley, we're seeing a technological juggernaut reaffirmed in America. From where you sit in London, with a transatlantic differential in technology excellence, what is Google, what is Amazon, Apple, Microsoft, and the rest? What does that mean for dollar dynamics in a presumed strong dollar?
Well, you know, if we go back just a few weeks, there's an awful lot of stock analysts saying, well, look, you know, tech's going to do poorly this year because we've got rising real interest rates, so let's look at Europe instead. So if you like these earnings reports, you know, do question that view. But I think there's something else in Europe today, and you've already been talking about it, that really is interesting. And, of course, that is the inflation print. And, you know, so many economists have said, well, look, we know that inflation is going to come lower in Europe. We know that because of base effects. It's got to come lower. But it didn't. Now, we had a warning of that last week because we had France and Spain and German national CPI levels going higher. But today we get that print from the Eurozone, and we know it's higher. And what does that mean now for Lagarde tomorrow? How is she going to react to that?
What is your trade now? Not so much a commercial hedge, but what is your trade right now to play European inflation that's unacceptable?
Well, you know, I think perhaps we're a long way from saying it's totally unacceptable, and we don't have as much wage inflation in core Europe land as we do in the US. I mean, that's for certain. And indeed, we can look at that wage data. If we look at the wage data, perhaps out to, you know, we've had it out towards the end of last year, there really isn't much wage inflation there at all. So a lot of the inflation will be eating into demand, and of course, that is a growth negative. So we do have to bear that in mind. This isn't the same situation as in the US, at least not yet. But even so, with that sticky inflation coming through, it is possible that Lagarde will feel, well, you know, she needs some more flexibility, that perhaps she won't push back against market expectations for an interest rate hike this year, perhaps not so much. And that sort of cements my view that certainly as we move further into this year, certainly in the second half of the year, it's going to be a lot more difficult, I think, for the dollar to keep on maintaining its strength, because there is going to be a different dynamic coming from other central banks, and there's so much priced into the dollar already.
All right, so Jane, you said that your 6-month euro-dollar forecast, euro-US cross, is 110. And yet you're saying that it's going to be hard for the dollar to maintain its strength. So what's going to be the trigger to shift it the other way?
Well, you know, we've got 110 for the middle of the year. You know, that's been penciled in, I think, since November. And the reason for that is that we think as the Fed interest rate hike cycle gets started, as the balance sheet reduction gets further into focus, the dollar can make more gains. And, of course, we're layering on top of that, of course, some safe haven bid as well. We've still got the situation, obviously, in Russia, Ukraine. We've still got North Korea. It's fired an awful lot of missiles into the sea this year already. So that's the reasoning why we think the dollar can go further. But in the second half of the year, you know, we've got the dollar giving back some ground. And I think at that point, the focus really will be on the ECB. How far can the ECB go? And what we've got to remember, even if the ECB can only do 10 at the end of this year in terms of interest rate hikes or the beginning of next year, what we've got to remember is what is priced in. And, you know, there's not an awful lot of suggestion that people are long euros, the opposite. And people are very long dollars. So perhaps, as Jonathan pointed out, it's changing probabilities, and they can really affect how the market positions itself in FX.
What's compelling to me is that amid all of the speculation about hikes from the Fed and now potentially hikes from the ECB, you're seeing ongoing strength or resilience, I should just say, in emerging market currencies. This belief that the rate hikes there will be sufficient, possibly, and also this idea that a lot of the nations are commodity producers that will benefit. Do you think that this has been overdone based on the fact that the inflationary impulse that we're seeing in Europe is probably going to be disinflationary over the longer term?
You know, I am worried about that. I think that we do need to look at emerging market countries separately and evaluate them individually. Now, certainly for the commodity producers, they've got commodity prices pushing up. That's going to be good for them. A lot of them, of course, in emerging markets have already taken action on interest rates. We've seen quite a few interest rate hikes going already in emerging markets. But, you know, it is the case that as the Fed hikes interest rates and the dollar goes up, it is difficult for those that have a lot of dollar-denominated debt. That is certainly a headwind. So, you know, I do think there is a vulnerability still in EM, but I do think we need to be careful about deciding which ones are more vulnerable than others.
Jane Foley of Rubber Bank. Jane, as always, from the heart of London, fantastic to catch up with you on foreign exchange, on euro-dollar and on EM as well. Lisa, in Brazil, we've gone from about 2% on interest rates at the central bank to 9%.
Yeah.
That was the move from last year. At the low to start the year, 2%. to finish the year in the nines.
Yeah, and taking a look at recession there as well. What's interesting is the real has done really well. It's raised into the highest level versus the dollar going back to September 16th. This double whammy of both rate hikes as well as commodity prices increasing, talking about some of these idiosyncratic stories.
Have they done enough to protect themselves from a rate hiking cycle over the Federal Reserve? That seems to be what a lot of people are thinking about.
Yeah, and that I think remains to be seen, and also what the Fed's rate hiking cycle will actually look like. You get the likes, though, of Mohamed El-Erian and others. I know you've spoken to him about this, getting very concerned about a rate hiking cycle being highly detrimental to some of these regions that have not accurately priced it. And I guess we'll just have to see.
We've got to see. And what I've heard from Fed officials over the last few days, Tom, I think a conclusion for a lot of people, they are just refusing to define a rate path from here. They just will not go there. They want to be open-minded about the whole thing. They want to be nimble. And I don't think you can say with any confidence or conviction where rates are going this year.
So we can use that language. Harker was on yesterday with operational research, and you can talk about choice set and optionality and all that. What's the optionality of Brazil? What's the optionality of Indonesia? Is they look right now at, let's call it 1 or 2% real GDP and 7% inflation in America, different from last 90 days. And John, how is that going to compare to the next 90 days in Q2?
We'll find out, Tom. We'll find out. And I can't tell you with any confidence of how this is going to play out whatsoever. Let's look at the range on the street right now. For the Federal Reserve, at least, we can be specific about that. Barclays at 3, Bank of America at 7. That's a big spread for a single year. Barclays at 3, Bank of America at 7, and then a pack at 5. No one knows, Tom. I keep going back to calling this guesses because I think these are guesses. They're highly educated guesses. Everybody who brings us these guesses, I have a tremendous amount of respect for them, but at the moment, you're not getting much guidance from the Fed, and that's deliberate. That is highly deliberate.
ADP in 45 minutes is maybe the beginning of the guest sequence here. I'm going to go out to March 11. John, we got to do the food channel more often. I mean,
Would you like
Twitter,
to do that?
they're lighting up.
What are they saying?
They're saying, forget about Rome, go to Puglia, where they do artichokes correctly, like Sicily. They got the stuffed thing going with the lemon and the breadcrumbs and all that. I mean, that's
my nonna used to do a lot of that to me, Tom. You're going to make me cry. That's why I can't talk about this.
This is
I always say forget about this. Right. The South always gets it right.
Yes.
Don't get me fired up. Futures up 1.6 on the NASDAQ. On the
I think Puglia could be in the Dow next year.
Road trip.
I'll take a road trip with you, TK. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. In the euro area, inflation surprisingly speeded up to a record in January. Consumer prices jumped 5.1% from a year ago. None of the economists surveyed by Bloomberg saw inflation accelerating, and it's the latest challenge to European central banks' plan to pare back stimulus more slowly than its counterparts in the US and the UK. Federal Reserve officials have a message for investors ramping up interest rate expectations not so fast. None of the 6 Fed officials speaking this week have backed the idea of a half-point rate increase in March. The most aggressive, St. Louis Fed President James Bullard said that 5 hikes this year is not too bad a bet. Some Wall Street forecasts, though, are calling for 7 increases this year. In Congress, there's growing Republican opposition to a once bipartisan bill intended to make the U.S. economy more competitive. House Republicans say the measure goes too easy on China whilst trying to aid the domestic semiconductor industry. The legislation is aimed at bolstering U.S. manufacturing, research and development. And Hong Kong has relaxed the rules it uses to release coronavirus patients from the hospital. That's a move that should shorten stays. The city is grappling with a growing number of infections that are stressing its health care facilities. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
You've got companies like Apple that are still cash flow machines. And as large as they are, they're still growing their cash flow at an incredible rate. They're unbelievably profitable.
Big tech just knocking it out of the park this quarter. From New York, that was Russ Kostrick, the portfolio manager at BlackRock, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. We've got a lift in this equity market again. 3 days of gains into Wednesday. We had some weight to the Nasdaq once more, eating into the losses of 22, up another 1.7% in the early part of trading today. Up 0.9% on the S&P 500. Crude up 0.2 on WTI. On Brent, basically unchanged. Let's call it up 0.1%. The headline that most people expected, Tom. OPEC Plus agreeing on a 400K barrel a day oil output hike for March.
And oil doesn't move off the 91 level on Brent crude down to 89.26 right now. Let's address Google and the path forward for Facebook and Amazon tomorrow. Kriti Gupta joins us now with wisdom on the NASDAQ 100. Kriti, what do you have?
Yeah, Tom, we got to talk about valuations, which is a rarity in these last couple of years when you do have this really kind of easy monetary policy. So to talk about valuations, especially when it comes to tech, is kind of a silly thing to do. But now that we're kind of staring a rate hike in the face, it's worth taking a look at the PE ratio of the NASDAQ 100, which brings me to my chart of the day. It measures just that, the idea that these kind of selling pressures that you've seen in the S&P 500 broadly, but really concentrated in tech, well, every single pullback you've seen over the last 2 years, well, it's kind of weighed on that numerator, weighed on the price, but also been aided by the denominator, the earnings piece of the equation. Alphabet, a blowout quarter similar to Apple and Microsoft. Meta Platforms and Amazon also expected to show some pretty good blowout earnings, and that's going to make the tech sector broadly just a little bit cheaper relative to the 35 handle on that PE ratio we saw in 2020. But keep in mind, we are still far, far more elevated than where we were pre-pandemic.
For those on the radio, yes, as Kriti mentioned, still elevated, but a really nice move back to some form of trend. on NASDAQ 100. This is a joy, and it is a joy of what Paul Sweeney did in developing Bloomberg Intelligence. Go out and get people who actually do technology and don't so much do finance. He has a CFA, but Mandeep Singh is with a senior technology analyst for Bloomberg Intelligence with real-world work, and in your case, SAP and Gillette and all the different corporate vendors you worked with over the years. What's the number one thing we get wrong when we study Google?
Well, so clearly we think about the growth rates and how the law of large numbers will catch up with the company eventually. What they showed us last night is the mature search business can grow above 30%. And they didn't have to, increase ad prices. It's an auction mechanism. And clearly there's a lot of demand for Google AdWords. And that's what they showed us.
What is, and John's brought this up a couple times, the magic of a 30% number. And I think of like a harmonic 30, then 15, and 7.5 to 3.25. Forget about that. What's the terminal revenue growth you perceive for something like Google?
Yeah, so it can compound at 20% for
You're going to put a 20 on it.
For the next 5 years. Beyond that, I mean, it remains to be seen how much of a contributor YouTube will be. We saw some deceleration last night. And look, that world can change. The video streaming world, when you layer in metaverse and NFTs, all the new things that are coming about, no one can be certain that these things will compound at, 20, 30% like search did.
Did Mandeep get the memo that we call metaverse Facebook?
Evidently not.
Memo?
He's calling it Meta. We're going to go with it. Mandeep, is this just basically a big story that it pays to be a monopoly?
Well, so they have a moat that is built around a proprietary search algorithm. A lot of companies have tried search, including Microsoft and Apple to an extent, and it's just the moat that they have around search is insurmountable, and they keep executing, and with the amount of data growing in the world, search becomes all the more relevant. There was a chain of thought that maybe with an app-based world, search may get disintermediated. That didn't happen because, there is so much to sift through, and having good search is what everyone needs.
Is there a message here, though, Mandeep, for some of the unprofitable tech companies that basically if you're trying to go against any of the behemoths, you've got a lost cause here because they are monopolies or they have such a dominant position that they will just snowball with any kind of economic gain? Is that what your takeaway is, that the divergence will only continue to grow between the non-profitable and the uber profitable?
No, I think you have to look at a case-by-case basis. But in the case of Alphabet, you can see how they are subsidizing the YouTube and the cloud business from the search cash cow. And anybody who's trying to compete in that cloud infrastructure space or streaming space has no odds of being successful just because of the amount of money that these companies are throwing at these two segments.
Do you have an Ida Tarbell moment where you wake up and say, all of this chit-chat about your world, which you've lived on both sides, the financial side and the sales side, the revenue, let's install it side. Do you ever wake up and say, this is Standard Oil repeating in history?
Well, so we know technology does get obsolete and it will be transformational. New things will come about and that will change. And that's why, we have to be on top of what's really driving the consumer value. What is it that the consumer wants in terms of technology and how they are consuming it? And that is eventually what turns the tide and, drives new businesses.
Mandeep, can we get an opinion on stock splits? Where are you on them?
Well, so I think it's their way of making the stock accessible to the masses. Apple did it, Tesla did it. And in my mind, I think it may be a good thing because you can see the run-up in the stock. And in this case, if they keep compounding top line at 20%, I think it bodes well for the valuation and a stock split does make sense.
Mandeep Singh, thank you, sir. In the same camp as Tom Keene, Senior Technology Analyst for Bloomberg Intelligence. TK, who's next?
Well, I think Facebook and Amazon got to talk about that revenue stream. I'm going to say, John, on this, you got three major accounting statements: income statement, balance sheet, cash flow statement. You meld them all together. Guess what? As Mandeep led with, it's about revenue growth.
The Dan Ives of Wedbush called this a Joe Burrow-like robust quarter. A Joe Burrow-like robust quarter. That's the Bengals quarterback, isn't it, Tom?
Nailed that, John.
Thank you. Former LSU player, too. Tom, did you see that Cincinnati have given the kids the day off school?
Loved it.
For the day after the Super Bowl?
Loved it. And the Super Bowl's actually on at a normal hour, unlike the World Series.
Can you answer this for me? Why don't they just push the Super Bowl up against President's Day? Why can't we just do that every year? And then everybody gets the Monday off. every Super Bowl.
I thought we get the Monday off. We have a surveillance thing on that. If you're American, you get Monday off after Super Bowl.
Is that the agreement?
That's the agreement, yes.
But why can't we just make that calendar shift, Lisa? Why can't the NFL do
I'm
that?
not weighing in on this.
Doesn't that make
sorry.
sense?
I mean,
just
honestly,
push the game up against President's Day.
We've covered shopping,
or as Amy, our producer, says, do it on a Saturday.
And now scheduling.
These are big issues.
These are big.
That need to be addressed.
John,
you can do it on a Saturday or push it up against President's Day. And Tom, the ratings would be better, wouldn't they?
For us?
I guess so. John, Anne-Marie from Rome emails in and says artichoke growth rate in the United States is 9.4%, which puts it on the edge
of the Dow.
Of the Dow. I mean, I'm sorry. Amalgamated artichoke is the next member of the Dow.
I'm so done with the Dow. I think it's all a big marketing ploy. I think that's what stock splits are. It's accessible if you want to buy Google anyway. Fractional share ownership is a thing.
Part of the fabric of America.
Days off.
The Dow is a PR machine, TK.
See that, Mandeep?
It's like GE. GE
Mandeep,
for me is the biggest boomer stock on the planet.
Mandeep's running away.
So's the Dow Index.
Like,
Mandeep, you want some tang?
If you quote the Dow and GE, they're just two of the most boomer things
Boomers.
in American markets.
Mandeep can't leave fast enough.
Trying to tweet TK from New York. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
It's all about financial conditions and how much do we need to see financial conditions tighten.
Companies have never been this profitable.
I think there's a lot of opportunity in some of the tech stocks that have gotten hit.
We think this is the year for be selective. I think it's very difficult to play the sectors.
Markets now need to correct to some level of normalcy, and that's what we're seeing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. It's all about Google, the alphabet from A to Z. It is up, John, January 26th, the VIX, 31.96. That was my entry point. I missed it.
What a change, Tom. The Nasdaq's still down 8% year to date, but we've taken a big bite out of the losses over the last 3 days. 3 days of gains, Tom, at more than 7% on the Nasdaq 100, and we're set to add some weight to it. The Nasdaq 100 futures up another 1.7%.
It's the quality of the gains, John, and what I'm seeing percolating out away from tech is, oh yeah, it's everybody else as well, and it's about a resilient margin level versus the gloom. Margins are going to disappear.
And Tom, how much confidence can you take away about the broader economy to see ad spend, ad growth in the Google business up more than 3% on the quarter? Is that a confidence play for you? Just a nice read on the broader economy, despite what we've gone through in the last couple of months?
I'm not willing to go there. I'm going to partition and say that the halves of technology, whether it's direct technology and not. And John, I mean, we got, Meta, Facebook this afternoon, and Amazon, but ever more important, I'm looking for the next UPS, as we saw yesterday.
We saw a big one from them, a big one from Alphabet after the close. Then it's onto Facebook, onto Amazon. You put the earnings together, great, solid, encouraging. You look at the bond market, bit of stability. I think that's helped out as well, Tom, just at the front end, to see two settle down just south of 120.
We'll get to the data and talk about the markets here. Lisa, I want to talk about the other America out there, and with this effervescence about technology, it's absolutely stunning how there are two discrete Americas.
And especially how the shift has been accelerated by the pandemic. I mean, as we get the labor market reports, and we're going to get the January report on Friday, how much have we seen a shift away from service sectors, from people-facing industries, to people where people can work from home and be in the office or not, and have more flexibility? I mean, this shift has been dramatic, and that really has been feeding into some of the wage increases we've seen for delivery, for hospitals, for educators.
Lisa, let's go to the wheelhouse. Douglas Cass on yesterday with Seabreeze. He says, watch credit, watch credit, watch credit. You are the arch credit watcher. What do you see?
Honestly, it's all good. I mean, honestly, you saw a pretty big sell-off in January, but it was pretty tame compared to what we saw back in 2013 with the taper tantrum. And you're seeing companies come to market. I mean, AMC is selling junk bonds today to refinance some of their expensive debt from the pandemic. AMC, of course, their shares have popped, and people feel like, well, we're all going to go back to the movies.
Can we frame that? Can we frame that line, Tom? It's all good.
It's all good.
Bramo.
It's like
2022.
The Bramo cam caught it.
Complete sincerity.
It's all good.
Honestly, it's like the sentiment shifts from one day to another are just whiplash. I mean, honestly, you're looking at a yield curve that's still just as flat as it has been in 2 years, and nobody cares because earnings are good.
I like how you said it's all good, then just sort of put in some snark at the end there. Did you like that, Tom? And then questioned her own sincerity.
It's like we're in the kitchen peeling artichokes on this show, on radio and TV. You don't see it on radio, but the way the chill from the Bramo cam is just extraordinary.
Freezing up sometimes, Tom.
When we do that. John, let's do it. Let's warm everybody up with a data check. John, I'm going to go to what's not moving, which is oil up $1.19, a bit of a pop here off the OPEC announcement. Brent crude 90.40.
Bramo, that meme, sitting there in the chair in that burning building, everything's fine. Futures up 9/10 on the S&P, on the Nasdaq up by 1.6. Yields coming a single basis point on 10s to 177.51. And look out, Europe, the Eurozone, inflation. It still has a 5 handle. We expected it to come right the way in on a headline number. Didn't happen. Euro dollar popped up 0.5% on that currency pair. We're positive. We're stronger on the euro. 113.26.
John, I'm going to mention ruble here. Dollar ruble's what I look at, 75. Make it a 76 handle, stronger ruble here this morning. Let's get to it and on the markets. Brian Nick with his chief investment strategist at Nuveen. What's the view forward, Brian? Do you adjust off of the tumult of January, what we've seen the last 3 days? How do you adapt at Nuveen?
Well, everything's happened so quickly that we barely had time to kind of revisit our outlook from the initial turmoil, and now we have this bounce back phase. It seems to be favoring growth again. We came into the year pretty optimistic about the economy, about earnings, and we thought that that would ultimately carry the day. We'd see tighter credit spreads, we'd see stable equity valuations, but rising earnings pushing indexes higher. And that's still our view for February through December, January notwithstanding. And I think that if you were selling the early losers in January, you've gotten whipsawed pretty bad by this. So I think it probably is a cautionary tale to not overreact to the first couple of weeks of the year.
Just drawn to an intraday chart of crude right now, Brian, 1.5%. We're just short of 90 at 89.50. We've had a monster move in energy equities at more than 23% year to date. That's a little more than a month. Brian, for the people that came into this year holding on to that story because it's really performed well for them, what advice are you giving them now? What do they do?
Right. So I think you're a combination of two things. One, sort of just the cyclical trade to start the year, coupled with the Russia-Ukraine tension. It's hard to kind of disentangle those two, which have the kind of the more primary factor in driving the oil price higher and energy equities. So what we're doing, instead of selling out of energy, taking profits, we're kind of scaling down. We're going into refiners. We don't want as much necessarily sensitivity to the price from here because we don't think it's necessarily going to stay at 90, especially if the Ukraine-Russia situation is resolved in some way. And I think we ultimately are going to get somewhat slower demand growth as the year wears on. So we do expect the oil price to go lower, but not getting completely out of energy because it is still one of the cheaper sectors, still making up for lost times over the past many years now.
Away from energy equities, what's the consequence on a broader portfolio basis if energy prices do rise from here? Not your base case scenario, if they do go to $100 a barrel or beyond.
Well, I think the interesting thing here is that the Fed seems more willing to consider things like maybe rising energy prices, things that it really can't control when it's deciding whether or not to raise interest rates. So what I would be sort of wary about if the oil price goes to 100 or higher is that going to make the Fed more hawkish ultimately because they really want to put a stopper in this inflation bottle? And ultimately, does that hurt sort of the longer duration areas of the equity market, the things that got crushed at the beginning of the year, like technology and some of the more defensive names? So I'd be sort of concerned about that bank shot coming back and hitting me if it's going to result in the inflation story being more persistent than it would be otherwise because of the durably high energy prices.
Can we broaden this out, Brian? It's not just the Fed, but if high energy prices persist, this could actually force the hand of the ECB, of Bank of England, of all of the central banks that have been sort of on the fence with whether to make a move or not.
Sure, those are all ostensibly central banks that are targeting core inflation, but there's no doubt that the inflation problem for Europe right now is mainly an energy one. They don't have the same kind of labor market tightness that we do here in the States. So they should really be thinking about inflation as being transitory in a way that doesn't seem like we're doing anymore in the United States. But even so, the central banks do have, I think, a proclivity to become a little bit more hawkish in their reaction function. And if we're talking about a systematic tightening of global financial conditions, that's not as friendly an environment for equities, even though they're still starting off at a very easy place and only tightening from really the loosest financial conditions we've ever had. There's still a risk there in that delta, that shift in direction toward tighter financial conditions being less favorable for the credit markets in Europe, but also for the equity markets. And they've had a relatively good start to the year if you compare them to the U.S.
Brian, can the easing out of China offset some of that?
I think it can. I think the places in the world where growth is conceivably or clearly weakening, like it is in China, those places are probably going to be more kind of postured to do an easing bias. But most of emerging markets is going in the other direction, tightening to get inflation under control. So China is really kind of swimming against the current here. It might make investors less nervous about China per se. So we've broadened out our emerging market story a bit to include China. We were kind of thinking EM ex China, but now China looks like a more reasonable investment case because of the valuation and the easing bias that they have. So I think maybe more specific to China in and of itself as an investment, and less about does the entire world benefit from Chinese easing.
Brian, you survived the whipsaw of Dartmouth economics, the optimism of the great trade guy Douglas Irwin, and then there's Blanchflower. Now, Blanchflower is gloomy and cautious right now. JP Morgan's at a 1% GDP. Can slow economic growth, a la Professor Blanchflower, can that derail your market outlook?
Well, first I'd say Doug Irwin was one of the best professors I had. Blanche Flower was at the Bank of England while I was there, so I didn't get a chance to have him. But yes, that's the risk is that there's some sort of exogenous, or we just get a faster deceleration in growth. People are working down those savings. A lot of the consumer story in the fourth quarter, and I think in the first quarter too, is going to be about consumers working down excess savings. And once those savings have run out, the savings rate at this point, the kind of the going rate of savings is not as high as it was a year ago. So the risk is that certainly by the third quarter, fourth quarter, growth is much slower, and maybe the Fed gets caught a little, maybe some other central banks too get caught a little bit off sides with the rate hike rhetoric and the action that they're going to be putting to work in the first couple of meetings this year. So yes, the risk for markets at this point, and the risk to the 10-year yield coming back down and the equity markets really deflating, is not necessarily the scenario where the Fed is hiking a bunch of times, because that's probably a scenario where the economy is quite good. It's the scenario that you point out, which is we're at 1% real growth in the U.S. by the end of the year.
Lisa, when's Danny on? Tomorrow?
Yeah, he's on tomorrow. I can't
Interesting.
wait.
Danny Blanchflower of Dartmouth joining us tomorrow. Looking forward to that. Hey, Brian, thanks for catching up, sir. Brian Nick there of Nuveen, looking at the bond market, which is pretty stable. Yields in a basis point on 10s to 177 on 2s. Unchanged, behaving itself. In the commodity market, getting really close to 90 on WTI, Tom. Just off the highs now. 89.72, the high of the session. We're back to 89.27.
It speaks, John, to the uncertainty forward. And, we go back to this cliche that we're data dependent, but we're also data dependent in commodity. Like, what do we do about coal? What do we do about some of these other topics as well? Coffee alone. I mean, I've had to cut back on the coffee and accentuate the tang.
Can you explain to the audience how much coffee you actually consume on a daily basis?
Embarrassing.
It's frightening.
It's like, I mean, the only one who has more coffee than me is George Clooney.
It's a lot.
Yeah.
Nespresso, Tom. Is that what you were talking about just then?
Yeah.
Do you think he drinks that stuff?
Yeah, of course he does. When he has his artichokes in Rome.
Yeah.
He's at the place in Venice on the canal.
I thought he was in Como.
He's in Como. He's got the place in Como above the place Francine takes me to. But what he's really got is a place on a canal in Venice. You wave to him when you boat by.
Down a basis point on 10s, 177. Look out crude, just north of 89. We'll talk about Facebook in just a moment. With Michael Nathanson of Moffett Nathanson next from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. OPEC and its allies didn't need much time to decide what to do at their meeting today. They've agreed to increase output by 400,000 barrels a day in March. Still, if the past is a guide, they'll have to struggle to deliver. In November, the group only implemented about 60% of its increase. Members from Nigeria to Russia have been running out of spare capacity. Russia's President Vladimir Putin is repeating his claim that it's the U.S. and NATO causing tensions over Ukraine. At the same time, Putin suggests that further talks could help resolve the crisis. U.S. and European officials say they are open to diplomacy, but they won't agree to a key Russian demand that Ukraine be barred from joining NATO. And in Europe, the energy transition is colliding with political reality. The European Union has unveiled how it plans to label investments in some gas and nuclear projects as sustainable. Member states are divided over what will receive the EU's green label. Those projects could attract billions in private finance. And Alphabet is bringing big stock splits back to the market. The Google parent announced a 20-to-1 split, dropping the share price from about $140 to almost $3,000. The split could help Google gain entry to the Dow Industrial Average. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
We're probably going to have a bad jobs report in the end of this week. I mean, just because of Omicron. I mean, it's just simply because of Omicron. That said, I mean, and the media will say, and I'm not criticizing the media here, but it'll say the economy only created X number of jobs. No, the economy has created millions of jobs. We just can't fill them. It's a supply constraint.
That was Patrick Harker, the Federal Reserve Bank of Philadelphia president, catching up with Bloomberg Surveillance. very recently with Tom Keene, Elisa Brabbits and Jonathan Ferro. Your equity market has a lift to it, off session highs, but still up nicely on the Nasdaq by 1.6%. On the S&P 500, up by 0.9%. Looking at the bond market with some real stability here. We come at a basis point on 10s to 177.33 after shooting higher on 2s. Yield short of 120 on a 2-year yield, just calming down going into payrolls on Friday and going into CPI next week. CPI next week, the estimates that we've seen so far here at Bloomberg, as we put those together, they have a 7 handle. Barclays at 7.3, Morgan Stanley at 7.3. The number comes next week. Ahead of payrolls, the ADP report just out. Let's get to that number. And this is a taste of what we could get on Friday. Here's Michael McKee.
Well, John, we're seeing a very good number from ADP. A very bad number, I mean, from ADP. They're seeing the first decline in months in payroll hiring. 301,000 jobs lost during the month, according to ADP. Members of the Wall Street forecasting fraternity have suggested that is a possibility, although the consensus is still, in terms of non-farm payrolls, a gain of 150,000. It looks like small businesses lost the most jobs, 144,000. Large businesses, 98,000. By sector, 27,000 jobs lost in the goods-producing industries, 10,000 in construction, 21,000 in manufacturing. Service-providing jobs down 274,000 jobs on the month. It looks like retail, the leisure hospitality sector that we follow so closely, lost 154,000 jobs. So a very dismal report from ADP, and this is certainly what Pat Harker and others from the Fed have been telling us could happen this month. And of course, the White House isn't going to be happy with the numbers, even though they know it was likely.
Well, the White House is setting us up for it as well. You heard from Brian Deese, the National Economic Council director, in the last 24 hours, predicting that this could be a soft one. ADP's come in with a massive downside surprise. I think, Mike, we should run through the estimates for Friday and just get our head around how important this number might be, or probably won't be. 150 is the median estimate. The range is plus 250 all the way down to negative 400. And I want to just go through a select few numbers here. Ethan Harris at Bank of America at a negative 150K for Friday. Want to go with Jake Bryson at Wells Fargo, negative 100K for Friday, negative 50K at Nomura. The reason I go with those three names, Wells Fargo still believe we get 5 hikes this year, and they're predicting a negative number this Friday. Ethan Harris at Bank of America still believe we get 7 hikes this year. They still look for a negative number this Friday. Nomura think we get a 50 basis point hike in March. They still think we get a negative print on Friday. There's a feel here, Mike, from the Fed to Wall Street, that this number this Friday does not matter. Do you push back against that?
I would push back slightly against that. The one reason I wouldn't think it would have a huge impact on the Fed is we'll get another labor report before the next Fed meeting. So if this is an Omicron-caused outlier, then we should see a significant rebound in the February numbers when they come out. Remember, we also have to compare the ADP numbers to private sector hiring, not the total number. Private sector hiring expected to be even lower than the overall 150 consensus, 113,000. So that makes the ADP number look even worse in comparison.
How much does this really edify what Patrick Harker was saying? This is not necessarily a demand side in terms of people looking to employ others, but rather people are either sick or are not able to join the workforce based on the JOLT survey yesterday that saw job openings climbing to almost 11 million.
Yeah, economists are still trying to figure out where everybody is and what they're waiting for, but we did have a number out from the Bureau of Labor Statistics, the Census Bureau, rather. They count the number of people who say they are out of work ill in a special survey that they do, and almost 9 million people said they either had COVID or were caring for somebody with COVID during the survey week for this payrolls month. So it is very possible that we could see the labor force start to rise. There are also millions of people who say they don't want a job right now because they're afraid of COVID. So it's hard for the Fed to know exactly when or if people will come back into the labor force, but if they do come back in significant numbers, just on a delayed basis, that would ease some wage pressures. So you can understand why Pat Harker and others are saying we need to be data dependent.
Mike McKee, thank you, sir. Looking ahead to more data next week, CPI in America. There's 2 more CPI reads, Tom, before the next Fed meeting in the middle of March. They're going to be key.
I have said March 11th is, for me, the key date. A lot of them are really important, John, but I'm going to go with that. Right now, in a broader conversation with Michael Nathanson, you've seen him quoted everywhere, as he deservedly should be. Say, senior research analyst at MoffettNathanson barely describes the fact he owns the phrase, content is king. Michael, I want to go to Apple, developing 550,000, almost 10 football fields of square feet in Culver City, out by Irvine. You know, there's this gigantic plant. Are Google, are Apple, are they going to take over everything?
It depends on which business we're talking about, Tom. I would say Apple and video, probably not. Google and advertising, probably yes. But Apple doesn't need to dominate in video. They've done great on their own. But, you know, the Google print to me is just, it's mind-blowingly good when you think about how large that company is and how fast they're growing.
We have heard from day one, the day Google went public, that there was a constraint on search. Everyone, including me, has been wrong. What's the x-axis of your terminal value when you look at search? Do you go out 5 years or 15 years?
Yeah, Tom, that's the point, right? That everyone fades growth on search to like mid-single digits. We go out 15 years on it because what is happening is big picture, search is getting more valuable in the world. As many of us stop watching linear TV, as Apple has put up blockers on, you know, for privacy, search just goes up in value because we're giving people intention, right? When you search, you're telling people what you want to see, and that is a perfect lead for advertisers. So that's been our thesis, that people underestimate search and just a long cycle of growth here, and that's the essence of the call on Google. It's better than you think.
Michael, do you think that this reduces the emphasis on diversification that a lot of people are looking for with the cloud, with YouTube, which actually disappointed?
You know, it's funny because, Lisa, when we look at the stock, you don't need diversification for the stock to work. We can just look at the core ad business. But I think in Google's world, they have so much talent in terms of technology talent. They have an incredible advantage in machine learning. They'd be foolish not to, you know, take that and lean into other businesses. So we're not giving them a lot of credit for Google Cloud or for other bets. But YouTube in our world, you know, is a really underappreciated asset. Again, going back to the big picture, it's rising in value. So, you know, we don't underestimate YouTube. So YouTube and search alone gives us enough upside for the stock without the other things really kicking in.
Michael, how much is Google an anomaly and sort of an idiosyncratic story of incredible strength and dominance versus a representation of an economy that's really recovering with advertising spending going up so much, even without travel picking back up to pre-pandemic levels?
Yeah, that's a great question. I think it is idiosyncratic because of search's value in the world and YouTube. When we wrap up earnings season for media, and other small ad companies, they will not grow nearly this fast, and they'll have problems with structural headwinds here. And Google has a tailwind that is unique to Google.
Michael, what did you and Craig think yesterday of AT&T doing a ballet from $15 billion spent on dividends to a modeled $9 billion? Oh no, we're not going to do that. We're going to do $8 billion. I believe the stock was down 6%. I believe that was the number. What does it say about escapades in entertainment?
Right. Well, Craig was here. He would take a bow because for the past 5 years, he's been saying AT&T can't sustain the dividend. It says that the cost of competing in streaming is incredibly high. That's been our call on streaming, as you know. And it says in the telecom world, the cost to compete there is incredibly high too, because of all the promotional activities being done, because of 5G build out. These businesses are a lot more challenging than I think the market thinks. And again, it's easy when you look at Google to say that's where you want to be. You know, we're relatively negative on streaming. They're pivoting out away from, and telecom as well in terms of mobile telecom.
Michael, just a final question from me. I think it's important not to let moments like this slip or slide. This is a $1.8 trillion name moving 10%. Michael, what do you make of that? Multi-trillion-dollar names moving this much. These are huge amounts of money.
Well, Jonathan, they grew their revenue, they grew their top line 30%.
Just unreal.
30%. Search has been around for 20 years, right? Search grew faster than YouTube this quarter. And again, if you stop back and think about what we learned this pandemic, this is about digital transformations. And Google has the best position in advertising because of what advertisers need to do. They need to pivot to search, they need to pivot to YouTube. And even though this has been around forever, the transformation of the pandemic has accelerated budgets. And I agree. When I first started covering it, I'm like, this cannot be as good as it looks. And now 6 years later, they keep going. They really do.
Just phenomenal. Michael, we appreciate your support on this program and your contribution this morning. As always, sir, thank you, mate. Michael Nathanson of MoffettNathanson. Tom, just bigger numbers coming off a much, much bigger base, and it blows me away every quarter we do this.
It's such a fascinating question, John. And of course, believe it or not, John, and I you know, if I'm wrong, correct me as you did on artichokes. But John, I believe Apple, as a general statement, is underowned by institutional Wall Street. There's still an immense doubt out there.
In some surveys of hedge fund ownership, Tom, I've seen some of the same things.
Yeah.
Lisa, it's
I did okay there, John?
You did okay, I believe.
Thank you.
Although Laurie Calvasina at RBC tracks that better than I do, and she'll correct you if you're wrong.
Okay.
Lisa, these numbers are just unreal.
Well, and that's why you're seeing a pop of a $1.8 trillion company of 10% in pre-market.
Just fantastic. The Nasdaq 100 up 1.4%, the S&P up 0.75%. We need to talk about that big ADP miss. It's setting us up maybe for a softer print on Friday too. Is it important? We'll get into that in a moment. From New York, this is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
We've got a ton to get through. Let's get started with Tom Keene, Elisa Bramis and Jonathan Ferro. Your equity market is positive. It's higher, up 1.4% on the NASDAQ. 3 days of gains into Wednesday. It's set to become 4 at the opening bell. The S&P 500 up 0.8%. Those two indexes with a heavy weighting, of course, to the NASDAQ on Alphabet and onto the S&P 500 as well. Alphabet with that big weighting, and Alphabet delivers in a big, big way. They deliver a stock split, 20-1, but also some massive ad revenue growth, up by more than 30% for Google for the quarter. So that's the stock story. I want to sit on the economic story as well and talk about the bond market.
Agree.
10-year yields coming a basis point, 178. We've just had a really, really soft ADP report. The ADP print came in at negative 301K. The median estimate was 180. The range on Friday ahead of payrolls is already super wide. 250 at the top end, negative 400K at the bottom end. And it's that negative cohort, Tom, that I'm interested in. How relevant is this Friday's print to the rate hike conversation? We heard from Patrick Harker, the Philly Fed president, who basically said, we can look through it. I'm focused on the inflation data. Will this market look through it this coming Friday?
John, we're making lots of fancy comments here on artichokes and all the hee-haw of Bloomberg surveillance. We're all dressed up and very fortunate the lives we lead. To me, the single number on Friday is 5.2%, which is average hourly earnings year over year. I don't care what inflation statistic you use, John. The fact is most of America is falling behind this February.
Well, Lisa's focused on jolts as well. And Lisa, job openings, I think, is an important point to make. If we get a weak print on Friday, what does it tell us, if anything, about this economy? Can we still say that this labour market is tight? Can we still say this is just about workers not being willing enough to come into the market for very good reasons, including right now, and the big excuse at the moment, a justified one, has been Omicron?
Yeah, and actually you compare the points that you're making and Tom's making, which is that the average hourly earnings could potentially increase quite substantially if the story is the latter, that people are not going back into the workforce, and this is a dearth of workers, not a dearth of willing employers. And that, I think, was the issue that Patrick Harker was looking at. Does this actually accelerate this wish by the Federal Reserve to tighten policy? I was looking yesterday, almost 11 million job openings just yesterday.
Amazing, isn't it, Tom? The median estimate Friday, 150K.
And on the claims tomorrow, we'll have that for you at 8:30 as well. Right now with Kroll Institute, a global chief economist, and that's an apt phrase for Megan Green with terrific transatlantic academic work. Megan, thank you so much for joining this morning. How do you do a 3-month moving average on something as emotional as the American labor economy? Do you single point it Friday, a grim number, or do you smooth it out to a moving average?
I think you have to smooth it out. And also, it's not like bad numbers on Friday will be a surprise to anyone. It's been very well telegraphed by the White House, the Labor Secretary, the Fed. The numbers should look pretty disappointing relative to what we've become accustomed to, but I've never ascribed too much meaning to any single data point, whether it's the jobs data or any other. And we know that our labor market is healing. The question, as you guys pointed out, is really where did all the workers go? And are they ever coming back? I think that's what the Fed really needs to know to be able to gauge exactly how tight the labor market really is, and therefore how they should be setting their rate path going forward.
Megan, a hallmark of your work is to wait for the data. What do you make of the present rate hike guessing parlor game? Is there any value to it? Or are you saying to yourself, I got to wait for pitchers and catchers to see what the Red Sox will do and also to see what the rate structure will be?
Yeah, more the latter, to be honest, Tom. I think that in 6 to 9 months, we're going to be having a very different conversation around inflation and demand. Demand will be weakening over the course of this year. I think supply chain constraints should start to ease over the course of this year. And the supply of labor should also start to ease as the virus abates. Now, that's assuming there aren't more variants. and certainly not more deadly variants. But as we move through this Omicron wave, I think that a lot of workers will jump back into the workforce. Those who are staying home either because they're sick or they're taking care of someone who's sick. Those who haven't gone back into employment from retirement because of concerns of being sick. And those who have had a financial cushion and so have stayed out of the labor market but have burned through them will have to jump into the labor market as well. And I think that will take a lot of upward pressure off of wages and therefore off inflation too. So, it just seems like a competition to see who can get more hawkish about the Fed's path going forward at the moment. I think that conversation should change towards the second half of this year.
This does feel, though, Megan, like a pivot point. And I talk about not just whether people come back to jobs, but which jobs they come back to. I've seen a number of surveys showing that people in manufacturing jobs are looking for office jobs, are looking to get retrained, want that flexibility to work from home. You've seen a complete sea change in terms of healthcare and education. How much will that increase wages in those less loved professions now that really got hit the hardest and were at the forefront of the pandemic?
Yeah, I think you're right. People don't want hourly services jobs. They're low-wage, low-hour jobs. People, I think, have been holding out based on the financial cushion they've received from stimulus measures and to avoid going back into them. But at some point, there's going to have to be some capitulation. And so I do think those jobs will be filled again. Also, something worth mentioning is that immigration is massively down over the past 2 years, and it was a lot of foreign-born workers who were also filling those jobs. Going forward, that should abate now that we don't have the same kind of travel restrictions that we had before. Biden's proposed some easing of immigration restrictions. And so those hourly services jobs should see some wage gains. It's the worker bees, the non-supervisory workers, who are actually seeing the greatest wage gains right now. And that should spread into leisure, restaurants, and bars as well.
Well, Megan, that's what I was going to say. I mean, are we going to see outsized increases in some of these areas where people have to be enticed back away from the cushion that they're depleting in order to not have to go to work there?
So I think wages have already risen quite a lot. And so as low-income households in particular burn through their financial cushion the fastest, as that cushion evaporates, I think the wage gains that we've seen will entice them back into the labor force. So I think that the supply side issue will probably abate. I mean, the best cure for high wages is high wages because people get pulled back into the labor force. And particularly once this wave starts to abate, it already has to some degree, I think we'll see the labor supply shortage ease as well.
Megan, can you just help me in understanding how some of the data on Friday will be put together, how it has been put together? You're the perfect guest to do this. Just got this note from Capital Economics. I'm going to share it with our audience just quickly. Because the ADP figures count everybody on payroll as employed, regardless of whether they worked or not, they do not capture the full hit from the Omicron-related surge in absenteeism. They go on to say, with an estimated 5 million Americans isolating mid-month, we suspect close to 500,000 of those won't have been paid at all during the survey period, which wasn't captured in the ADP figures, but will show up in non-farm payrolls. Megan, can you just explain the technical situation around how this data is put together and how it might show up on Friday?
Yeah, so that's right. The ADP is often not a great indicator of how the non-farm payrolls will go, though the direction of travel seems to be correct or similar in both these cases, assuming that we get a disappointing headline figure for tomorrow. But it is down to classifications. And so a number of people weren't able to go to work either because they had symptoms of Omicron or they had Omicron, and they won't have received a paycheck. And so that doesn't show up in the ADP data, which is only people who are receiving paychecks, but that will show up in the non-farm payrolls data.
Megan, I want to go the Transatlantic Act with you. And right now what we're seeing is maybe a yield structure in America that migrates higher, and a Europe yield structure, which some would say stays where it is, maybe even with negative interest rates. What is the outcome for our viewers and listeners of such a spread, a difference in yield across the pond?
Well, we're seeing monetary policy divergence, which should push yields up in the U.S., particularly at the short end. Whereas the ECB, investors have started to price in hikes for this year, but at a much more gradual rate than what we're seeing in the U.S. That means that, you'll still be facing negative yields in Europe, whereas there will be much more positive yields. Now, I don't think the long end will go up significantly in the U.S. I've been asked, why would anyone buy a 10-year government bond with a 2% yield? And it's because you could go elsewhere, Europe, Japan, and it will be negative. So, the U.S. Treasury ends up being the cleanest shirt in the dirty laundry basket.
Megan Green, wonderful, as always, with your experience out of Europe too, of the Kroll Institute and the Harvard Kennedy School. Just to build on that number from Capital Economics, here is the number. They think there could be an even larger decline than the 200K drop that they had penciled in. That was their forecast into Friday. And talking of big numbers, Goldman out with their estimate for Friday, Lisa, negative 250 this coming Friday.
How will this change the conversation? We've just been hearing from Megan and frankly from a lot of government and Fed officials that they're expecting a low print. So does it really make a difference if you don't see necessarily any other commensurate weakening that has lasting power?
Just no idea. I mean, should it change the conversation? No. Will it? Who knows? We'll find out on Friday, 5 minutes after the print. Neil Dutter of Renmac thinks it shouldn't change the conversation. Neil Dutter, Tom said, going into today, you have to treat the January jobs number as a very bad weather event. Payroll growth is delayed. It's not derailed.
John, Primerica, Meta, Alphabet as well. John, the Commanders are on the Eagles' 10-yard line.
Do you want to explain to our audience, Tom, what do you, is this a new name?
For our global audience, John, is there any parallel to this in England? The Washington Redskins are now the Washington Commanders. They're finessing the message here this morning. That is the Joe Theismann over there, one of the bravest guys in football, had to retire with a horrific injury, John. It's seared in everybody's memory this Sunday that happened, and they're managing the message with the great Joe Theismann this morning.
The old name became controversial.
Yes, absolutely.
Very quickly,
no
and over time, of course, too. The new name will be controversial, Lisa, for about 5 seconds, and then ultimately everyone's going to move on.
I agree. I would agree. And I think that there is a very large debate. I think that it highlights, if you want me to make this a broader story, which I will, the political issue right now and the conversation that's actually affecting the elections more than, say, Ukraine, Russia. And this actually feeds into that.
The Commanders.
John, I think it really works versus the Guardians in Cleveland. I mean, the Commanders is such a military...
You don't like the Guardians? The Commanders?
No, it doesn't mean anything nationally. Commanders, we understand, is the heritage of Washington and our defense.
Got an important interview coming up a little bit later in the next hour on Bloomberg TV and on Bloomberg Radio. Mary Barra.
You ask her about the Lions.
The GM CEO. We'll talk Detroit Lions. We won't. We'll talk about the transition to EV and the amount of money they've got to spend to do it.
Yeah.
From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. New figures indicate that private sector payrolls in the U.S. fell by 301,000 in January. That comes from the ADP National Employment Report. Earlier, the White House said the brief absences of workers due to Omicron could overstate the number of unemployed people for last month. The January jobs report, of course, comes out on Friday. In the euro area, inflation surprisingly speeded up to a record in January. Consumer prices jumped 5.1% from a year ago. None of the economists surveyed by Bloomberg saw inflation accelerating. It's the latest challenge to European central banks' plan to pare back stimulus more slowly than its counterparts in both the US and the UK. In Congress, there's growing Republican opposition to a once bipartisan bill intended to make the U.S. economy more competitive. House Republicans say the measure goes too easy on China whilst trying to aid the domestic semiconductor industry. The legislation is aimed at bolstering U.S. manufacturing, research and development. Hong Kong has relaxed the rules it uses to release coronavirus patients from the hospital. That's a move that could shorten stays. The city is grappling with a growing number of infections that are stressing its healthcare facilities. And in pro football, the Washington team has a new name. The team formerly known as the Redskins will be called the Commanders. In 2020, the squad dropped its old name and its Indian chief logo because of complaints that they were offensive. The last 2 seasons, it was known simply as the Washington Football Team. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
what do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of individual circumstance and, decisions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The good news is that markets have been aggressively repricing future tighter money supply and tighter Fed policy. But the bad news is that the Fed hasn't really even done anything yet.
Troy Gajewski, FS Investments there on the markets. Right now, Lisa Bramwitz and Tom Keenan, we are going to clear the air on bonus season and the great misconceptions that are out there, and we can really do that with someone qualified, Barry Ritholtz, writing for Bloomberg Opinion, but far more in the game of financial management. Okay, Barry, you and I know the game. You got a guy who nailed differential equations like you and I did not. They're really good. They're on some form of trading desk or syndication desk, and they unload a $5 million bonus. How much does the firm make if the trader makes $5 million so they can afford to live next to Barry Ritholtz?
Well, typically it's about a 30% payout. So assume the firm is making $10 million, but it's really the bonuses are really the wrong way to think about it. Bonuses perform two functions for the employers. First, it's a giant retention tool because it keeps people there till the end of the year. They don't get their bonuses till January or February. But secondly, and perhaps more importantly in the post-financial crisis era, it's a risk management tool, meaning there's a tendency for someone who's on a hot streak to lose a little bit of their humility, a little bit of over-optimism creeps in. They make more and more bets. If they know that they're going to give that money back, or worse, go into the red, and they're not going to see any of it, there's a tendency to behave a little better. And so even if there's a disaster, well, we've held back all this bonus money. It offsets the loss. So it really works as both a check on traders and a risk management tool for the firm.
Barry, I take real issue with the who are these guys attitude. And the answer is most of these people making this money, it's not luck, it's prodigious math skills, prodigious quantitative skills, and as you've emphasized in your career, terrific behavioral skills.
Yeah, that's the key, because let's look at some data just to put some meat on the bones. You had more than 1,000 IPOs last year. It was an all-time record. It was more than double 2020, which obviously was an off year due to the pandemic. But that doesn't just happen. There are people working in the trenches trying to get that done. You had record issuance of green bonds, of junk bonds. Munis were very, very close to a record. And then think about the S&P 500 up over 27%. Think about everybody on a prop desk at a hedge fund, any option trader. You know, not everybody gets those bonuses. You hear about the $5 million bonus. You don't hear about, you know, the bottom half of that trading pool that, you know, they're lucky they're still holding on to their job. It's a very fathead, long-tail distribution.
Barry, to that point, there has been a shift among some financial firms to increase the salary portion and try to increase the fixed costs also as they talk about expenses and reduce the proportion of the bonus. What's your sense of whether that works as a strategic move or whether it backfires due to the risk reward and the risk management tools that you were talking about?
You know, it depends if you're going to end up with a two-tier compensation system. You could set up a bunch of rules for the NBA, but LeBron is going to have his own comp structure. And the same is true with people like Tom Brady. They have to operate within the within the parameters of the team, of the firm, of the amount of revenue that particular division or desk generates. Yeah. But that said, if you say to a guy or a woman who's creating $20, $30, $50 million in profits for the firm, hey, we're going to pay you on a flat salary, they're going to laugh at you and go across the street where they'll take that 30% bonus and get it bumped up to 35. And when you're making tens of millions of dollars in profits for the firm, a 5% bump in payout, it's millions of dollars.
Barry, let's talk about the competition, because we've heard from every single bank that the war for talent is very real. Is the war for talent with other banks or is it with big tech companies?
So it's both. So you have internecine warfare and then warfare with other fields. And when I look at various MBA graduates, law school graduates, people who come out with engineering degrees, we've watched over the past 30 years as different sectors are doing better or worse in the economy, they tend to draw the most talented people. So we've watched people run to technology. We watched them go to Wall Street. We've watched that group go to venture capital. We've watched them move back to software and other forms of tech. You know, look at what's performed the best over the past 2 to 4 years, and that'll give you a lot of insight as to where the top tier grad schools are sending their graduates.
Barry, you told me to buy Google at 98. You bought it, but far more importantly, you held on to Google at 98. You're going to get a 20-for-1 split, Barry. You're going to have thousands of shares, I say, thousands. How do you hold on to a stock like Google through thick and thin?
You know, I'm just about finishing up Sebastian Malaby's new book, The Power Law.
Talked to him yesterday.
I recall, that's why I'm bringing it up. And towards the end of the book, there's a chapter on Sequoia. And Sequoia started out as essentially an early round investor. But when they ran the numbers and figured it out, you know, selling into an IPO, they left so much money on the table. They recognized the transformation of the economy from the industrial age to the computer age, which was very hardware driven, to the current age, which is, to quote Mark Andreessen, software is eating the world. And so they ended up setting up subsequent funds to not only hold on to growth stocks, but also set up a hedge fund so they could bet on the downside. When they see software and cloud rising, they want to bet against hardware and, you know, old telecom. And so you have to recognize all the different phases of a company's life cycle, when we look at something like Google, and I'm with you, guests, I can't call it Alphabet, it's Google, they have had and are likely to continue having a dominant role in our mobile and desktop internet for a while to come. Now, I can't tell you if that's 5 years or 50 years. Nobody really knows what's coming next, but it's been a fantastic run. The only reason a lot of people who have been riding Google for a long time should be selling it is at a certain point, you don't want anyone's stock to be 20, 30, 40% of your holdings. That's just too much concentrated risk. And the best way to lighten that up is to just say, okay, I'm going to sell 1% of this every month for the next, 3 years.
Out of time. Barry, go get your Washington Commanders merch as they change from the Redskins to the Commanders. Barry Ritholtz, thank you so much. Greatly appreciate it. Lisa, just brilliant there on the bonus conundrum of Wall Street.
Yeah, especially at a time when a lot of people are criticizing the banks and saying that the high comp structure is why perhaps they don't have as much momentum. This argument basically making the other case.
We continue through the day. Somehow Facebook and Amazon maybe a little more important than they were 36, 48, 72 hours ago. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Big tech bouncing back in a big way. From New York City this morning, good morning, good morning. The Nasdaq flying. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, big tech bouncing back.
The mega cap tech companies.
How resilient.
Stunning results.
Alphabet, it's a real bellwether for the whole industry.
That's obviously giving some comfort back into that portion of the equity market.
Technology is one of our favorite areas.
Quality companies with strong balance sheets.
We're going from a year last year of a trifecta of tailwinds.
We're at a turning point.
Rising rates.
A sea change in terms of Fed policy.
NASDAQ. The sell-off that we have seen. These are dips worth buying.
It just requires, again, a more careful look through some of these names.
Joining us now to discuss JP Morgan's Mira Pandit, Hightower's Patrick Fruzzetti, and Chris Harvey of Wells Fargo. Mira, I want to begin with you. Is this a move, this bounce to the NASDAQ, that you've got some confidence in?
I do have some confidence in this move. I mean, I think that the re-rating we saw in the beginning of the year had everything to do with this rapid rise in rates, which tends to hurt some of the growthier areas of the market. And we did start earnings season off with a bit of a rocky start in some of the reports, but we're starting to see things pick up. And ultimately, these are companies that do have access to some of these long-term secular growth stories. As growth slows in the second half of the year, investors are going to need growth in their portfolios. And these are some of the interesting core holdings.
Chris Harvey, I smiled when I saw your name in the rundown for this morning. I smiled because we had a good laugh last week about the technical language you used, the cathartic puke in big tech. You thought it was time to buy the dip. It's delivered in a big way over the last few days, Chris. Why the confidence for you?
Why the confidence for us is we were expecting a 10% pullback. You had a lot of froth in the market. We weren't worried so much that systematic risk is so high, there's no price for risk. What we were saying is you needed to reprice risk. You did that. We're seeing, and what we've been saying for a long time is you just have to be more selective. The whole market's just not going to go up en masse. And at the end of the day, the fundamentals are still okay. And you can make money on this market, especially when you get a 10% pullback.
Chris, you've said the upside is limited. Can you frame that for us as we look through the rest of this year?
Yep. Yeah, John, again, it gets back to last year. Last year was a fantastic year. You had monetary accommodation that was through the roof. You had fiscal accommodation was through the roof. You had a recovery like nothing we've seen before. And now what we're doing is we're reversing a lot of those things. Fed policy is going to become more aggressive. We don't have the same fiscal policy that we had. Growth is decelerating and valuations are higher. You shouldn't expect the same type of returns. You really need to manage your risk. You need to manage your growth expectations, and you need to manage what you get from your portfolio. There's just not the same upside that we've seen. Right now, we think there's 3-4% upside right here, right now, and we would be buyers. Again, we'd be buyers on a pullback, but we wouldn't be chasing things.
This year, as you've said, is a year potentially for multiple compression. I want to come to you on that, Patrick. This is a difficult one to answer. I get that. You don't have a crystal ball. But to what extent do you believe that we fully discounted the Fed's move this year?
I don't think we've fully discounted it, and frankly, I think the move that began in January will resume. We've had a little bit of a head fake rally here. I think the move from growth to value will resume trend. I mean, we had inflation hitting 7% for the first time in 39 years. Look, I agree with Chris that you have to be selective for sure, but there's really way too much noise in the market. And if you filter through it, you just know that the Fed, is really trying to set inflation expectations. Frankly, this talk of 4 or 5 or 6 rate hikes, I don't think ultimately comes to fruition. I think they'd be lucky to avoid a major market crisis if they actually went through with that. They know they can't do much from the supply side, but, in the end of the day, investors are looking at cash flow. And, when you look at the rise in commodity prices, If you look at things like the energy sector and raw commodities, ag commodities, everything's continuing to move up. I mean, just this morning, I mean, I know there's a major storm moving through the middle of the country, but nat gas futures are at 530. Brent crude is above $90 a barrel. I don't think that that's anything that's going to change in the near future.
WTI came really close to a 90 print as well a little bit earlier this morning. That's at 89.15 right now. This rate hike game continues. At the front end, I've got the likes of Barclays at 3. At the very back end of the conversation, I've got Bank of America at 7 for this year. The St. Louis Fed President Jim Bullard basically said maybe 5. He said the following: the markets are pricing in 5. I think that's not too bad a bet right now. 50 basis points, I don't think help us. Mike McKee, I want your thoughts on this. So 4 or 5 seems to be where the Fed speak is at the moment. 50 basis points, not right now.
Yeah, not right now. They're pushing back on that. Some prominent folks on Wall Street, and you know who you are, suggest the Fed is behind the curve and will have to be aggressive and maybe even raise 50 basis points, which is a strategy that's now been embraced by absolutely no one on the Federal Reserve. You can see what they've been saying the last few days. 6 members of the Fed speaking. And basically, I don't have to read them all for you, but basically the idea is that they have to be data dependent. They can't define a path right now and just stick to it, is what Philadelphia Fed's Pat Harker told us yesterday, because Fed doesn't know exactly what's going to happen with Omicron and the economy going from here. As you mentioned, top Wall Street banks also, it seems, in competition with each other to try to outguess how many times the Fed will raise rates this year. Fed officials say that, too, is a mistake. The reason is COVID. They thought they had a plan for the economy. They thought they had a plan for inflation. Then came Delta and Omicron. So what are they going to do? They're going to watch the data, as they say. Wall Street will have to as well. They will be data dependent. Here are some of the key numbers to watch. Payrolls come up twice before the next meeting, including on Friday. CPI a couple of times. We get a PCE report, retail sales, and ISM services. We're going to have a little trouble trying to decipher what happens with payrolls because we're expecting a very bad number on Friday. The ADP number today comes in negative 301,000, again, because of Omicron. And so the Fed's going to have to take that into account and take into account the fact that the following month will probably be even more confusing because there'll be a big rebound. Right now, we're looking at that range, John, you mentioned 250,000 positive to negative 400,000. I assume that is going to change and maybe move more towards the downside.
Well, let's talk about the downside. And Mike, thank you. Let's talk about those numbers. Negative 150 is the number, the estimate coming from Bank of America. They still think you get 7 hikes this year. The estimate coming from Wells Fargo, negative 100K. They still think you get 5. Goldman believe you get 5. They're at negative 250K for this coming Friday. Nomura at negative 50K. They believe you get a 50 basis point hike in March. I think for a lot of people, they believe this number just does not matter. Brian Deese of the National Economic Council for the White House, I think he agrees.
We never put too much weight on any individual month. This will particularly be true in this month because of the likely effect of these short-term absences from Omicron.
Mira, I want to come back to you and get your thoughts on this. Does that Friday print matter or not?
We could very well see a negative print on Friday and probably a challenging print for the January number as well, given some of the Omicron challenges. But I'm not sure that that's going to be the data that skews the Fed into a more dovish direction, because ultimately, a lot of the measures that they're looking at, whether it's quits or job openings, are still incredibly tight. We do have an overall tight labor market, and ultimately with 7% inflation, that's really the number that they're paying attention to more.
Patrick, what will you pay attention to this Friday?
Yeah, look, I don't think the number is going to mean too much, quite frankly. I think the 6th straight month of 4 million people quitting their jobs is important. The fact that there's a record 10.9 million job openings in the country. I think those are the things that the Fed is going to focus on. I just think they're going to have to be very careful, in these rate hikes. 50 bips, as a first Fed hike move, I think would be absolutely ridiculous. Again, unless they want to create some major volatility in the markets.
2 CPI prints before that March number. I mean, I'm not on board with it either, but you never know. You never know. Neil Dutter of Renmax saying this: you have to treat the January jobs number as a very bad weather event. Payroll growth is delayed. It's not derailed. Chris, there's a consensus here going into Friday. I understand it. Most people do. There is an issue here, though. Consumer sentiment's not exactly great right now. you're making the point that you think peak pricing power is behind us. Are we going to see a demand hit off the back of some of this?
Yeah, John, let's just talk about the Fed for a second. And just on Friday, what we think is you've just seen the biggest sick out of your entire life, your entire career. That's all that is. Now, with regard to the Fed, I'm not sure where I stand at this point in time. A few weeks ago, there was nothing to see here, and now Powell is Mr. Inflation, and we're talking about 5 and 6 and 7 hikes. It's a little odd. And the other thing is we're seeing break evens come down. Chinese New Year has occurred, so the flow of goods into the U.S. is slowing down, right? If we're going to make some headway into the loggerheads in the supply chain, now is about the time you would do it. We have, the phrase, the other catchphrase we use is the U.S. consumer spent like a drunken sailor post-recovery or post-pandemic. A lot of that demand has been satisfied. There's not a ton of pent-up demand left at this point in time. So it's not clear to me what they're trying, what's motivating them. And maybe the only plausible argument I can really understand and stick my teeth into is they're attacking a behavior. And that behavior is we're very worried that people believe that prices will continue to move higher. We're worried that people believe that we'll always have higher wages. And we want to break that belief. Because a lot of the things that we're seeing is we're seeing the economy slow down. We're seeing a crack in break evens. We're seeing possibly a pause or some improvement in the supply chain or potential improvement in the supply chain and some belief that maybe the worst is behind us, right? Not that it's going to get better anytime soon, but maybe we peaked. So I'm a little bit not confused. I'm uncertain about why. And if it is because of that mentality, okay, great. If there are other things going on, I'm not really sure how this is going to work out. If you're going to raise 5 to 7 this year, you're going to slow down the economy. You're going to slow it down greatly, and we really have to be concerned.
Chris, does that make your market call harder?
No, it actually makes my market call easier because we're only expecting 3 or 4% upside from here. And what I think is we could possibly we could rally. We are rallying. We could rally a little bit more. That doesn't mean that we're going to hold those gains. If the Fed does get more aggressive, maybe we don't hold those gains. And maybe we get another opportunity or bite at the apple, right? And maybe as they slow things down and they realize that we've had peak congestion, right? Maybe they start messaging to the market that 5, 6, 7 is a little bit too much in the second half of the year. Then we can start to have a better environment. And the last thing I would say is it looks like we're going to have a very aggressive sweep. It's going to be a red sweep this time. And the Senate, that moves from Democrat to Republican, is usually pretty good for the market. So we do have some catalysts in the second half of the year.
We can build on that in the second half of the show. Chris, stay close alongside Patrick and Mira, sticking with us. Let's get you some single names. We have got to talk about this move in big tech. It's led by Alphabet. Here's Abby with more. Hey, Abby.
Hey, John. Well, it's really pretty incredible. Alphabet absolutely crushing it, as one analyst at BMO said. The stock now up more than 9% in the pre-market, on pace for the best day since March of 2020, just below 9% at this moment, fluctuating around that big number. And they, of course, put up a big quarter around all of the segments, 25% growth in every business. Top and bottom line results beat. Search and advertising business, super resilient. This pandemic strength sticking around, at least for Alphabet. And they're also doing what Apple and Tesla did back in 2020, or a stock split, the optics of a lesser amount of a stock, in this case 20-1. As we know, it doesn't change valuation, but to some retail investors it could make it more attractive. And of course, John, we have all the other mega cap names getting a nice sympathy lift. Big results there.
Abby, thank you very much. Coming up, corporate America is starting to find its footing amid rising cost pressures and persistent supply chain constraints.
Supply chains around the world are very constrained, and it is a difficult supply situation. The uncertainties are going to be here I foresee it into 2023, actually.
Still ahead, the perfect guest to discuss this with, the GM chair and CEO, Mary Barra. That conversation coming up. With about 17 minutes out until the opening bell, there is a big lift on Wall Street this morning, led by Alphabet. Google absolutely surging. Equity futures up 0.6% from New York City this morning. Good morning. For our audience worldwide, the opening bell just around the corner.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
14 minutes away from the opening bell in New York City. There is a lift to this market, a nice lift on the equity market, on the S&P 500, pushing higher on the NASDAQ by much more. On the S&P up 0.6%. With your movers, let's get across to Abby. Hey, Abby.
Hey, John. Well, let's take a look at the shares of GM and other automakers, because we have a nice lift there as well. This, of course, after GM put up a very respectable quarter relative to profit beating. But I think it's probably the outlook that investors are so excited about. Outlook is very strong in terms of the growth expected for 2022. They're looking for 22% unit growth in 2022 on pent-up demand. But the big focus, or one of the big focuses for many investors, of course, is the electric vehicle, their push into EV. And what a push it's been. They are looking to spend $7 billion on battery supply expansion. That's $14 billion since 2020. But what really stands out is their goal to produce 1 million electric vehicles by 2025. That, of course, is Tesla's current goal. Chomping on the bit, chomping on their heels there, John.
Abby, thank you very much. We've heard from the chair and CEO, Mary Barra. This was the quote that jumped out for us all. With an improving outlook for semiconductors in the US and in China, we expect our 22 results will remain strong. There's been a big lift to the outlook on volume. Maybe some visibility coming through on the chip supplying issue, and that's what we need to get our teeth into in just a moment. That's going to be a big, big issue, not just for GM, for the whole industry in 2022. I'm very pleased to say that joining us now is the GM chief, Mary Barra. Mary, fantastic to catch up with you. I want to whip through the Southside research off the back of these numbers. Dan Ives Wedbush, buy. Laying major groundwork for a game-changing EV strategy. Citi, a positive outcome. It increases our conviction, buy. Jeffries and Philippe Houchoir is a little bit more balanced on this. He seems surprised by the volume guidance. 2 to 3 times bigger than what they'd heard coming into this. Where's that coming from, Mary? Where are you getting that visibility from?
Well, as we look at the year, we've been working closely with the semiconductor manufacturers, our tier ones, to make sure that we, have the best possible forecast for what we're going to be able to build this year. Recall last year we were hit a bit hard with some of the COVID impacts in Malaysia, so that's where we see, the opportunity to see on a global basis, greater than 25% increase from a production perspective, and that is assuming that we're not going to have any, dramatic changes from a COVID or a supply chain perspective, but we feel very confident. And also what's exciting is we know there is strong demand for our vehicles. So I think 22 has the opportunity to be a very good year.
I want to hit that demand story in just a moment. Clearly there's a balance at play through last year, and you nailed that balance with the stock performance we saw. A balance between the chip access and pushing it towards the higher price vehicles. Now it's almost the opposite. And I think there's some disappointment around that, Mary, that you get the better access, you get the better volume, but the average price comes down. How do you balance that? How do you optimize the balance there for 22?
Well, again, we had record performance this year, and again, hats off to the GM team with all the work that they did, the challenges that they overcame. And as we get into next year, not only are we going to be selling across many more segments. Last year in 21, we focused on our most in demand and capacity constrained vehicles. So as we open it up to, other allocation to chips to other products, it is different from a profitability perspective. And we also are investing in growth. And so, we're investing for the future. We know there's a huge opportunity, not only from an EV perspective, an AV perspective with Cruise, but also across the board from a software perspective, whether it's ICE or EVs. We see an opportunity to really grow from a services and subscriptions perspective.
Mary, you've got to help me with the numbers when it comes to CapEx and investment. The numbers we've seen in this industry are just huge. The team here at Bloomberg came out with a story. Ford yesterday throwing another $20 billion at this transition. You said, quote, we're going to be increasing spending. That much is clear. Is the answer always going to be more when you're asked how much you need to throw at this story, Mary?
Well, we've already announced between 20 and 25 that we're going to invest $35 billion, and we've been investing that. Big announcement last week in Michigan, $7 billion for conversion of a plant to build trucks, EV trucks, as well as our third battery plant. We're pulling ahead our fourth battery plant. We'll be making that announcement in the first half of this year, as well as an additional EV truck plant. So we're seeing the demand for our products, and we're seeing customers' willingness to adopt EVs. That's what's causing us to pull ahead. We're going to continue to do that, and we've got the capability to do that. And you'll just see our number grow as we continue to invest in EV and AV capability.
Right at the end of the call yesterday, you talked about the dividend. Mary, where is it? When does this dividend come back? What do you need to achieve to bring that back into play?
Well, we've had a capital allocation framework for the last several years where first we invest in opportunities to generate a return on invested capital of greater than 20%, as well as have an investment grade balance sheet and then return the rest to shareholders. And that's what we plan to do. But with all the opportunities we see in front of us to accelerate on EVs, accelerate AVs, and accelerate the software-defined vehicle, we want to make sure we have maximum flexibility. And that's why we're not reinstating the dividend as we currently assess the situation. There still are other mechanisms to return value to shareholders, but we want to have the flexibility to really support our growth.
Do you think buybacks make more sense? Is that what you're trying to say there?
Well, again, I think there's three pillars of our capital allocation framework. To me, making sure we're investing in creating value and growth, I think, is the best thing we can do for our shareholders. But if, at the end, we have excess capital, we are going to use one of the mechanisms to be able to return that to our shareholders.
You've mentioned demand a few times. Let's go through the numbers. The numbers are staggering. You've talked about this pent-up demand in the American market of several million vehicles. On the EV side, I was looking through the orders, the reservations, 59,000 Hummer EVs, 110,000 electric Chevy Silverados. I'm sure that if you open the books again for some of these names, they'll go again. They'll go again. Mary, have you ever seen demand this great in this country for this transition?
I just am really encouraged by how much interest there are in EVs. Last year, we started to see a tipping point. And that's why last year we and in 20, we started accelerating our push to EVs. And, we're uniquely positioned from a traditional OEM because we have the Ultium platform that we started working on several years ago. We launched the first vehicles off of it last year with the Hummer. And so that's enabling us to move quickly, but also have scale from a battery perspective that will, I think, give us a really efficient margin as we make these transitions. So I'm very enthused with the interest in EVs, the reservations, as you say. And I also think it goes to the fact that our products, our EV products off of Ultium, offer a lot of advantages from a range, from a performance, flexibility. So this transformation is pretty exciting.
I can tell you're excited about it. I can tell you're excited about the margins. I can tell you're excited about the demand. Here's the delicate question. Why does this industry then need credits, need tax credits?
Well, as you look at EVs, we do need to get customers into electric vehicles. We've seen that The incentives do help drive EV adoption. And remember, we have aggressive goals from frankly, a country perspective and a global perspective from what we need to do for the environment. So we think that will help, especially as all companies work to get battery costs down. I don't think it's a forever thing, but I think right now to get where we need to go from a market perspective, from a climate change, it's appropriate to do. What we're asking is let's make it a level playing field. We were a first mover. We're already out of today's credits, and we're saying let's uncap them so customers can truly buy what they want.
When you say make it a level playing field, what do you make of the extra credits going, if this was implemented and pushed through by the White House, what would you make of the extra credits going to companies that are selling cars made with domestic union labor? Does that sound like a fair playing field to you?
Well, you know, again, every workforce has the right to unionize, so it's a choice that they're making. We're at General Motors. We're represented in the United States by the UAW and unions around the world. We've done a lot of great work together. So, again, every company can make their choice, and the workforce can as well.
Well, the White House has got to make a choice too, and you support it. I want to go through these credits. They're pushing for a $4,500 additional credit for vehicles that are made using domestic union labor. You get an additional $500 for manufacturers that use domestically produced batteries. And Mary, one thing that I've been confused by is why the push here? You've just gone through the demand story. It sounds fantastic. You're excited about it. I see the same thing at Ford. I don't see a demand problem here. I see an infrastructure problem, which the government could be focusing on. Mary, why do you think we should be focusing at all on tax credits? You sat in the White House in the last couple of weeks, and you supported that. You said getting strong demand is very important, but we have that demand. So, Mary, again, why should we be focusing on that in any way, shape, or form?
Right. Well, I think what we're looking for is we have strong demand, but, when you look at how many EV sales there are today, we're in the single digits. We need to, by end of decade, to get to 50%. And so that's where you've really got to have the right portfolio. That's what we're working on. But you've also got to, move the customer and get their interest. And so to get to the levels of adoption, we're just in the early phases right now. And I think that's important. Also, infrastructure, EV charging infrastructure is very, very important. And the bipartisan bill that was passed for infrastructure, I think, is going to move the infrastructure along with what startup companies are doing. We're investing about $250 million in charging to make sure that any customer, even customers that only own one vehicle, know that they can count on their electric vehicle for their daily drive.
Mary, as you know, little mention of the Bolt EV in your letter. Some people have been raising a question as to whether that whole project gets canned as you retool your plants around the country. Mary, you're committed to that. Why does that still make sense?
I'm sorry, could you I couldn't hear your question.
Sure, just on the Chevy Bolt, just on the Bolt itself. There's been some problems there, as you know. Some people have raised the question as to whether you should just ditch the whole project and focus on what you've been doing subsequently, which seems to be attracting massive demand. Why does that push there still make sense?
Well, first of all, it's a great product. I was most recently driving a Chevrolet Bolt EUV, and it's just a peppy vehicle, fun to drive. Our customers that have bought Bolt EVs or EUVs are some of the most satisfied customers in industry, not just with a GM product. So it's a great product. We had a very specific issue with LG, our manufacturer of the batteries. We have worked with them. That's been corrected, and we're seeing strong interest. And so that the Chevrolet Bolt EV and EUV will be a very important part of our near-term future for EVs.
Have you got an EV market share goal for this year, Mary? What is it?
Again, I'm sorry, you're coming in muffled. I'm so sorry.
That's okay. I'm happy to repeat myself. Don't worry. Do you have an EV market share goal for this year? And if so, what is it?
We're working between 22 and 24 as we accelerate vehicles to sell 400,000 or plan to build and sell 400,000 vehicles by the end of 2023. So, and that's just going to ramp up from there. So we're very optimistic about the strength of our products. And as we build them, again, we're seeing with the reservations they're sold. So that's our goal for the 22-23 timeframe.
A final question from me. You've also taken the helm of the Business Roundtable in America too. For you personally, what are the big goals there for you?
Well, again, I think business, when we look at the transformation that's happening in almost every industry, I think business working together and also being a partner to move the country forward is very important. So I'm very proud of my BRT role and representing companies as we look to move to the future and, really create a stronger country. So a really important opportunity, and the work that BRT does is so important, so I'm honored to be able to have the opportunity to lead them.
And we're honored to have you with us this morning. Thank you for being with us. Looking forward to catching up through the year ahead. The General Motors Chair and CEO, Mary Barra. Looking ahead to the opening bell, this is the situation for you about a minute out. There's a big lift in this equity market. On the chip supplier side of the story, GM giving you some hope for the year ahead. For Alphabet, just the cyclical appetite for ad revenue, for ad spend seems to be absolutely fantastic. Ad revenue there up by more than 30% for the quarter in Google. That's giving the NASDAQ 100 a major lift here, up by 171, up by a little more than 1% on the NASDAQ futures. On a Russell, up by just 0.04%. On the S&P 500 futures, they're positive a 0.5%. If you switch up the board and get to the bond market, here's the story for you going into payrolls. Ahead of payrolls, we could get a negative number after what we've seen on the ADP report. Treasuries settle down at the moment at 179, 178.76. Yields going nowhere. Euro dollar one to watch. Inflation in with a 5 handle. We did not expect that. The ECB coming tomorrow. Full coverage here, of course, on this program. Euro dollar 113.18 and crude up by 50 cents, up 0.6% to 88.74. That is the cross-asset price action. The downgrade starting pretty early this year. Ed Yardelli, the first one out of the gate, trimming his S&P 500 price target to 4,800 from 52, writing, quote, Chair Powell and his colleagues have been making the tough transition more painful. My message to the committee, the labour market is strong. Inflation is a problem. Can we just get on with what needs to be done, please? Chris, I want to bring you back in. You raised the point, what needs to be done. You're confused by what they think needs to be done. Run me through that again.
Right. Yeah, so we were really worried about inflation 6 months ago. What we said is, or what I've said is, we had never seen the kind of pricing environment we had seen in the first 6 to 12 months of last year. I turned to my analyst in the summertime. I said, give me 3 stocks that are raising prices. I said, Chris, pick any 3 stocks. And what we were seeing from the consumer is the consumer didn't care about price, right? There was no, you could raise price, and we joked around about this. You could raise price 10%, the consumer would say, I'll take 2, you know what, make that 3, okay? And that's when you should have been attacking it. But what we were doing is we were still buying bonds at that point in time. We were still adding accommodation. It's odd, okay? Now what we're seeing is we're seeing a normalization of the consumer and the consumer spend. We're seeing inflation and inflation expectations come down. Maybe we've seen a peak in the supply chain. Maybe we've seen peak supply chain issues. The other thing that I've been trying to say rather ineloquently is it's not just about supply, it's also about demand. We saw retail sales go up 20% from the pre-pandemic peak in about 20 months. It took years post-financial crisis to do that. So I'm not sure why they want to accelerate everything right here, right now. And what I'm worried about in the past is they've stuck around too long. They stuck around with a taper for too long. They stuck around in 18 for too long. And maybe they will do 5 or 6 or 7 hikes and tell you that we really have to take this mentality out of the marketplace. I don't know, but the economy is already slowing down. If you're going to attack it with higher rates, you're going to shrink the balance sheet. You're going to have a big effect. And part of it is where we came from. You threw so much stimulus at the situation last year, and for the last 2 years, it's going to be in stark contrast. And I'm not sure, if you get really aggressive, I'm not sure how well the market can take it.
The NASDAQ move up 0.6 on the NASDAQ, an early part of trading up about 3 minutes into the session, up about 0.6% on the S&P, up 0.4%. Mira, I want to come to you. PayPal's getting absolutely hammered. Alphabet's doing really nicely off the back of earnings. When you look at tech, how selective do you want to be at the moment?
You definitely want to be reasonably selective at this point. I mean, a lot of the easy money has been made in 2020 and 2021, and we saw an enormous rally. So we certainly want to look under the hood to understand those profitability trends. Now, a couple of mixed reports don't necessarily mean a company is no longer viable in a portfolio. We can expect that reports increasingly will become a bit more mixed as we head from this heady phase of recovery to a more recovered environment. But nonetheless, I think we do need to re-underwrite our positions, and we're probably not tossing a lot of them out. You know, we keep the best and we leave the rest, but certainly being selective and active in this environment will be important.
Patrick, your thoughts on tech right now?
Yeah, I don't find many of the high multiple stocks very attractive, but I will say anything that kind of falls into the payment space is interesting just because there's been so much volatility from the highs in that space. So if there's any area we're looking at, it would be there. But, quite honestly, I think, Chris was just mentioning this, every time the Fed has tried to tighten or frankly ease less, in recent memory, the market has just met it with unforgiving action, right? And so, I just think there's going to be more volatility in the months ahead.
Google looks good. 4 minutes in, we're higher on Google, on Alphabet through much of this morning. Let's turn to Ed Ludlow on the West Coast in San Francisco for more. Ed.
Good morning, John. Yeah, strong beat, top and bottom line. And this is broad-based growth driven by search, right? 33% ad sales growth overall. And you have to remember that the fourth quarter ending in December was the Omicron quarter, right? And the two mainstays of search are travel and retail, but not a problem. It seems to have done well. Cloud business doing well. John, I don't know if you're into TikTok. I don't think you're a TikToker, but did you know that YouTube has an equivalent product called YouTube Shorts? And it's interesting because they hit 15 billion daily views on that platform. So there's growth in YouTube as well, although they did miss YouTube in terms of sales estimates. And one worrying concern is, of course, that YouTube is the most sensitive of Google's portfolios to those ad tracking changes made by Apple. But let's get to the real news, right? The stock split. And the rationale here, according to Ruth Porat, CFO, speaking to Bloomberg, is making this stock more accessible. 20-for-1 split, okay? Bringing, the shares roughly to $138 a share based on Tuesday's closing price, issuing 1/10 cent for every Class A, B, and C stock out there. So this is interesting, and I thought that the thoughts of Brian Novak at Morgan Stanley were most interesting, that this puts pressure on Amazon, right? There's this intense battle right now for capital. Alphabet and Google aren't just doing the stock split, they're being more shareholder friendly generally, right? Disclosures, shareholder returns, splits. He wants to see that potentially happen with Amazon, for example. Stock splits have been out of vogue since 2007, 2008. Now we have this comeback driven by Apple, by Tesla, and more recently, Alphabet. And now who else is on the up today, John? Meta Platforms. So you want to see how much does, how much does this translate to a broad read on the ad business and by extension, the macro picture as well?
The stock split conversation drives me nuts, and Tom Keane knows that better than most, and you know that too, Ed.
Yeah.
Amazon in focus, I'm sure, a little bit later this week. Don't apologize. The stock's doing lovely off the back of all of this, up by 9%. You had a great story out yesterday, Ed, just on the Ford spend.
Yeah.
It's interesting to me that Dan Ives of Wedbush is now covering not just the tech names, but also the likes of GM and others. Ford have thrown another $20 billion at this, Ed. When's enough enough?
Yeah, it's really interesting because it took a long time for the street to kind of give GM and Ford credit because they're balancing the shift from combustion engine to EV. They don't start with a blank slate like Tesla did. As you said, sources told us that this is 20 billion on top of 30 billion already stated. And Tesla is the roadmap. Sources telling me that Farley sends Tesla articles around internally to execs and team members saying, guys, look at this. This is the roadmap. But we are getting serious now. I really enjoyed the comments of your guests previously. Delivery, right? Mary Barris says 400,000 next year. How many this year? What is the near-term, medium-term roadmap?
Ed, this tax credit story is so controversial, especially if you're Elon Musk, and I do want your opinion on it, your view on it as you report on the subject, on the topic. It does not seem to me that we've got a demand problem in America for these vehicles. There seems to be massive demand. At the same time, they show off the order book and the reservations. They're also lobbying the White House to offer more credits, and I just don't get it, Ed.
Yeah, I think that this is a supply-constrained industry, right? If you go on Tesla.com right now and you want to buy a vehicle, you'll wait until July in the higher-end models and almost a year out to December for others. When Ford talk about why they haven't given hard long-term deadlines, they talk about the consumer credit angle of it, or the consumer incentive package of it, because that will be a further driver of demand. Like, these are vehicles for higher and middle-income families. Not everyone spends 40 grand on a vehicle, John, in America. And so I think that that's the tipping point that folks are looking to. When do we go sub 30? And then that opens up to America that need a single family car, and incentives are really closely tied to that, based
That's
on what I'm
a really,
reading.
really important final point, Ed, and thank you for it, sir, as always. Ed Ludlow on the West Coast. Mira, I want to come to you on this big EV transition and where to play it after we've seen massive gains for the likes of GM, Ford in the last 12 months.
Look, electric vehicles, like vehicles in general, are very capital intensive, and this will be a space that we are in the early innings of. There will be a few winners and a number of losers. I mean, if we think about where we were 100 years ago with the internal combustion engine, there were something like, hundreds of car makers. And now today there's 3, 4 or 5 prominent ones in the United States. So it definitely lends itself to consolidation over time. Right now, we'd think up and down the supply chain when it comes to EVs, though, not just the cars themselves, but the batteries, the technology, the infrastructure required for the charging stations, the commodity inputs. There are a number of ways to access this trend without necessarily going into some of the names with super high valuations and without dependable production.
Mira, build on that, because for many people who missed the run-up in the car names, the auto names through much of last year off the back of this big transition push, they might feel like they've missed it, and they're trying to work out the pockets of the markets that still have a decent entry point. Can you be more specific across the whole chain that you just described, where you think that is right now?
Sure. I mean, I think that among the producers, some of the names that are entering the market that already have a track record of production, either in the EV space or more broadly with cars in general, and have that technical know-how, may be able to scale up a lot easier than some of the brand new names that don't have this production track record. But if we think about some of the broader elements of the supply chain, certainly semiconductors is a long-term area where we're going to continue to see investment, not only for EVs, but a number of other applications, whether it's AI or robotics. So having that multiple strands of applicability will be really important. And I think that also from a commodity perspective, you know, commodities tend to be very volatile. We want to be very careful about what we own, but there's some green shoots here given the fact that this will be a very commodity intensive transition.
I've mentioned Dan Ives of Wedbush a couple of times, so let me bring up the quote just quickly. Alphabet delivered a Joe Burrow-like robust quarter, further boosting the confidence of tech investors. The bears will now go back into hibernation mode. If you're outside of America and don't know who Joe Burrow is, former LSU quarterback, now of the Cincinnati Bengals, goes to the Super Bowl. Chris Harvey's so proud of me right now. Chris, let me turn to you. Can the Bears go back into hibernation, Chris?
I am really proud of you. Here's what we would say on tech, and it's true, and we've been saying this for a year, and it's true for all stocks across the board. If you're looking at things on a multiple of revenue, that's not where we want to be. We don't think those stocks really work. Yes, they're going to bounce. They are bouncing. If you're looking at stocks on a multiple of earnings, then we can have a conversation. That's where we think the opportunity is. We think a lot of companies that are growth at the right price have really derated here. We think there are a lot of companies with good secular pricing, as we talked about with pricing. Not everyone's going to have pricing going forward. And what we want is just really good risk rewards, whether that's in tech, whether that's in consumer, or in financials.
Patrick, final word, sir.
Yeah, I just wanted to mention one thing that Mary Barra mentioned, and she, in this tremendously strong CapEx cycle where they've been spending a lot of money and talking about capital allocation and not reinstituting a dividend, I think companies for the past 10 years hadn't been rewarded much for either instituting or growing a dividend much. I think that's changing. And so I actually think that could be something, by next year they may quickly revisit that policy.
Patrick Frizzetti, good to catch up. We're going to build on that story. Mira Pandit, thank you to you. Come back soon. Chris Harvey as well. He's so proud of me. Thank you, Chris. We've made up after all this friction over the last few years over his price targets. Coming up, the White House. Warning on payrolls.
The survey was done roughly around the week of January 12th. There were millions of people that were still not in work. A lot of them were out sick. Some folks were out sick. Right. And if they were not eligible for paid leave, they're going to be marked as not working when in fact they are.
Really important chat coming up ahead of payrolls. That's next. This is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We never put too much weight on any individual month. This will particularly be true in this month because of the likely effect of these short-term absences from Omicron.
Brian Deese, just laying the groundwork ahead of Friday. The White House warning the jobs data might be ugly. Meanwhile, more bad news for the Biden administration on the domestic front. Senator Joe Manchin calling Biden's economic agenda for Build Back Better effectively dead. Whatever we are going to come up with, anything you want to be put on the table, we can talk about. Bloomberg's Anne-Marie Hordern in D.C. joined us for more. He did not want to talk about Build Back Better, Anne-Marie.
No, he certainly did not. For him, this was over in December, Jonathan, when he made that bombshell announcement on Fox News that Sunday that had everyone scrambling that he is not going to continue those negotiations. But he did signal that there are things that he wants to work on, especially when it comes to the tax code and lowering prescription drugs. He said that that could be, quote, extremely doable. So maybe not Build Back Better in name, but some of those chunks and those pieces the president was talking about. So that's one side of the eco agenda for the Biden administration that they're dealing with. The other is, of course, basically them coming out in plain English as much as they can, saying that Friday is going to be a bit of a dismal day for them in terms of the jobs report. And really, when you look at the analyst forecast, Jonathan, they're all over the map in terms of the non-farm payroll numbers, as low as negative 400,000 to as high as 250,000. Now, if they think this week is going to be bad, next week's inflation print, Jonathan, Barclays, Morgan Stanley, 7.3%.
I'm with you.
It's going to be tough.
I'm with you. You can make excuses up for Friday. Everyone already has. They make perfect sense. They're justified. Omicron. Chris Harvey of Wells Fargo called it the biggest sick out you've ever seen. We get it. Next week, that CPI story, north of 7. We spent a lot of time talking about geopolitics, AMH, and I just wonder how quickly this is going to transition to the domestic issues going into the weekend.
I think it certainly will, right? And I mean, you made that point this morning on surveillance. While we're all talking about geopolitics and while it is taking a lot of the oxygen out of the room of this White House, at the same time, is that really what resonates with voters, with Americans? What they want to hear this administration move on is inflation. And that Michigan Consumer Sentiment Index, 75% of those surveys, those consumers say inflation, 75% inflation is their biggest worry. And then if you look at the subtext of that, it doesn't really move much on partisan lines. So it's Democrats and Republicans.
AMH, thank you. On consumer sentiment getting hit by inflation, looking ahead to next week, it could have a 7 handle again. It could be a little bit higher. Crude right now, 88.71 on WTI. On Brent, 89.64. OPEC Plus agreeing on another gradual output increase. They're sticking to their plan. Not much is changing here. I want to get to Julian Lee of Bloomberg, who knows way more about this situation than I do. Julian, very close to a 90 print on WTI. Yeah. What's the latest?
Yeah, very quick OPEC meeting. The full ministerial gathering was over in just about a quarter of an hour. They rubber-stamped another increase for March of 400,000 barrels a day in the target production for the group of countries. Their actual production isn't likely to rise by as much as that. The latest figures from OPEC for December show that they were already pumping more than 820,000 barrels a day below their target in the last month of last year, and that's likely to slip further as several countries can't meet their rising obligations.
Julian, is there anything the White House can do about this, the administration? They take a lot of stick for it. They tried to do something at the back end of last year. It's clearly not worked out in a sustainable way in the way that they would have hoped for. Is there anything they can do?
I think it's very difficult. I mean, the problem is that there are a very small number of countries that have significant spare capacity to boost output more. Saudi Arabia, the United Arab Emirates, maybe Iraq, although there are questions about that. But even if you're successful in persuading those countries to put more oil on the market more quickly, what that does is erode the spare capacity to cope with any sudden unexpected disruption to supply, whether that comes from a geopolitical flare-up or whether it comes from an accident somewhere. And as that spare capacity shrinks, so the market gets more concerned about its absence, and that tends to fuel the price rises too. So what we're suffering from, I think, really is 2 years plus of massive underinvestment in keeping production going, in bringing new fields into production, in maintaining output in existing fields, coupled with a very strong rebound in demand growth that at the moment appears to be outstripping supply. But, and it's a big but, if you look at the forecasts of the big agencies, whether it's the US government, the International Energy Agency, or OPEC itself, they are all forecasting that the oil market will move back into a situation of oversupply during the course of 2022. And if that materializes, that may take some of the heat out of prices.
Julian Lee, looking forward to catching up through the week on a big story for crude. It just keeps inching higher. It just keeps going. Julian Lee of Bloomberg, thank you. Looking at big tech on a move today. Alphabet up nicely, up 8-9 percentage points or so. PayPal down hard, off by 25%. You miss, you get punished. With more, here's Kriti Gupta.
Yeah, good morning, John. It really is that tug of war between tech. Of course, Alphabet taking the cake as the major index contributor. And you can see on a sector basis, that's really pushing it higher. The communication sector is going to be in the lead here, of course, bringing with it the likes of Facebook, Snapchat, Twitter, even Match platforms as this kind of social network. To the downside, though, you do have energy, which is your laggard. This, of course, follows those muted returns following the OPEC meeting you were just talking to Julian about. I really want to highlight, though, that kind of divergence in the tech space, because you mentioned PayPal, but information technology, consumer discretionary, they are lagging today, and that could make or break the index. But like I said, it really is Alphabet that is taking the cake. And you can see that in the media services index actually bouncing back from a pretty aggressive correction, John.
Kriti, thank you. On a sector price action, up next on the program, we've got to work through some central bank decisions, the ECB, the Bank of England, then on to payrolls Friday. A lot to discuss. Your trading diary is up next. From New York City, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg Bloomberg.com webinars.
Five minutes into the session, equities doing okay on the S&P. Off session highs, though. I think you were hoping for more than this. Up a third of 1% on the S&P. On the Nasdaq, up a half of 1%. Nasdaq getting a lift from Alphabet, of course. Google making up about 8% of the Nasdaq 100, 4% of the S&P. Just in terms of the member weighting, that big shift higher, 9% or so far this morning. Helping us out a little bit, the Russell of small caps underperformed, negative 0.6%. Bond market looks like this, through 190, then we back away, through 190 last month. Right now, 176.98. Through 120 on twos, we back away. Down another 2 basis points to 114. Going into some really important economic data tomorrow. That's the price action. Here's the trading diary. A White House press briefing on COVID-19, 3 p.m. Eastern time. Then Facebook reporting after the closing bell, followed by Amazon on Thursday. Plus, the ECB and Bank of England delivering rate decisions. Does the Bank of England go again? And can the ECB wait this one out? Rounding out the week with the main event, the payrolls report this coming Friday. 150, the median estimate. I think we're preparing ourselves for that to move lower. 250 the high, negative 400K is the low. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of Lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their Lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a Lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of Lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching the streets. So we have mounted our own campaign, even in the U.S. He flew to America and he hired 2
consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way.
Hello traders, how are you doing today? Are you ready to place an order? I'm going to sell short Japanese yen. The price I'm looking to sell, 114.92. Please place your order. It's very close to actual price, so you must be quick, okay, in order to fill this order. 114.92. Order placed and position opened. Okay, you still have time because it moved up. You still have time to sell short Japanese yen. Okay, guys, I'll stay with me. All of you who decided to trade today, stay with me, and I will guide you through this trade, and we will close this trade together in profit. I want to remind you that we still have some short positions on Japanese yen. So we'll try to close if everything will go as we expected. If not today, by the end of this week, we will close all these positions in profit. If you want to find out how we trade and what indicators we use, how we trying to trade, how we're trying to find out how much money we have to invest. You need to get the strategy. It's not free. You need to go to company.co.uk and purchase the strategy. Afterwards, you will have to copy and follow our trades for a couple of weeks. And there you go. You can go and trade other securities, indices, or pairs, whatever you decide. As you can see, it started to move down. So stay with me and I'll speak to you later.
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some passed the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, Meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in